Hey guys, hope you and your families are doing well. This is the live coaching session for the 7th of May 2024. This one, as part of the Blueprint trading course, is going to be section 1, but we're now at 2.1, which we're into the different types of stocks. There's 3 types of stocks I look to trade: true market leaders, momentum leaders, and also group theme leaders. Focus of this one is going to be first and foremost an overview, and then we're going to go into true market leaders. At the end, I'm going to try and make it a little bit more tactile for what it's like in real life. So try and give you the information which I think is applicable, specifically focused on TML type stocks. But what you'll also notice, and what I'm going to try and do in the second half of this session, is line up stocks from the same group or similar kind of themes, whether it's oil and gas stock, whether it's defense related stocks, whether it's banking, financial related stocks, as we've got here with Citi and JP Morgan, whether it is gold mining stocks I'm looking at fairly closely now. And then it's about trying to reach a conclusion for why you doing what you are doing when you are doing it, and going really deep into the proverbial Alice in Wonderland rabbit hole. Because what you tend to find in my experiences, as you can see, say precious metal miners now, is you have HMY, this on today's date, HMY being a gold miner, and then PAS being a silver miner. So both precious metal related stocks, both are setting up. So it's very common to get stocks from similar groups, similar themes in the market setting up around the same time, and quite commonly on the same day. They'll put in trigger bars, check out demand tails, gap down reverse bars. They'll be around 10-day, 21 days, potentially clustering a 10-21, and the 50 is there. So then it's about the second half of this session is going to be about how do you then reach the conclusion for which stock you are then, for me, what stock I'm going to be targeting the next session. So I'll try and take you through my thought process for things I think about, both in terms of the fundamentals, so trying to keep it dialed in terms of true market leaders, but then bringing in some other important considerations. Stock's 20-day ADR percentage, what's the relative strength looking like? What are the earnings? What are the sales? What's the liquidity of the stock? Thinking about the initial stop loss relative to the 20-day ADR percentages. So this one is going to be one of those much more, I would say, kind of advanced sessions. You have to watch it twice if you're a little bit newer to trading. There's going to be a fair few kind of advanced concepts coming at you pretty darn quickly, because I talk quite quick. So let's start. So this is just going to give you an overview of what we're going to be covering in this session and then the next 2 sessions. So there's three types of categories. So when I am looking at a stock, I try and categorize it. And as I say here, a stock can appear in multiple categories, and the more proverbial boxes it ticks, for me, the better in general, right? The technical action is going to be very, very important. But what is a true market leader? O'Neill, I've got the book over there somewhere. O'Neill, how to make money in stocks book, basically sums it up. This is the canceling criteria in essence. I would add a couple of things that I like to see to it, which are going to be kind of in the momentum leader side of things. So big earnings, big sales, big estimates, improving margins, new global product. Doesn't necessarily have to be a global product, but a huge addressable market. So total addressable market, you'd like it to be mega, and potentially there is more growth on the horizon. So potentially they have a global product, but maybe they're just in the States or they're just in Europe, and they're going to expand into America, and that opens up a whole new market. We're going to talk about the importance of a company's earning when we get into a couple of charts: institutional liquidity and high quality sponsorship. So institutional liquidity, a high 50-day dollar volume, so potentially about 50 million, 100 million, 500 million, over a billion. Okay, liquid stocks, and then potentially a great story behind the stock as well. So this may be company is relatively new, maybe it IPO'd in the last 3 years, 5 years. They've got triple digit earnings, triple digit sales. The estimates for this year are 50%, for next year are 100%. The margins are improving as well. Their product is only currently being sold in Europe, but they're expanding out into Asia and also the Americas. That there is going to be a pretty good story. So whatever widgets it is they are selling, whether it be digital, whether it be physical, so you want to understand that kind of thing, right? Momentum leader, so what I'm looking for here is a high 20-day average daily range percentage, which is your ADR percentage, ideally greater than 3 times the major indexes. If you keep in your head that the SPYs and the Qs on average are going to be around about 1%. It ebbs and flows, sometimes up to like 1.25%. Okay, it depends on volatility in the market, but if you keep in your head around about 1%, so momentum leader type stocks, you really want to see a minimum 20-day ADR percentage of 3%. A lot of the better ones will have 20-day ADR percentage of 4, 6, 8% and greater. Liquidity, 90-day dollar volume or 50-day, I could say 50-day dollar volume actually, to be greater than 100 million. it doesn't have to be that high, but you want some liquidity in there. Okay, so 100 million is a good kind of starting place. Sometimes you get some good ones around 50, 75 million, but right in 100 million, that's where you tend to get the better ones. Also, we speak about the character of the stock a lot, so it moves and trends well for traders. So you want to look back, get a feel for it. Okay, this type of continuation type base, flag, pennant, wedge. Okay, set on the 10-day or the 21-day, put in a shakeout demand tail, then it trended. How did it then trend? Did it stay above the 10, the 21, the 50? What do you think would be optimal? Do you think it would have been more optimal in terms of optimizing the profits to choke some or all of the position off, lower the day, lower the day, lower the day if it gets extended from the 10? And you want to go do that for multiple breakouts in terms of, or kind of pullback entries, the type of setups you're looking to trade. So you're trying to get a feel for the stock, and do traders like trading this? Okay, traders don't like choppy, horrendous stocks. We just don't like them. So you want those kind of smooth movers. Okay, want to understand the type of market participants playing around with that stock. Short-term high relative strength ranking is what you'll usually see with these kind of momentum leaders, like the RS line on a 1 week basis, 1 month basis, potentially 3 month basis is really turned up. So you can think about it in terms of relative strength rankings. Also, relative strength line I think is good. Can be it doesn't have to be, but can be a polarizing company and or story. So you think about, it could also be the CEO is also polarizing. You think kind of Elon Musk recent years in terms of Tesla, like pretty polarizing company, really interesting story. And Elon Musk, I love him. He's Marmite basically. People either love him or hate him. There's very few that are just in the middle somewhere. That's what I'm talking about in terms of polarizing, which can then create a high short interest in the stock. For me, high short interest, anything greater than 20% of the shares outstanding, so the float has been sold short. You start getting like 30%, that's getting really high, like above 40%, really high. And then you have group theme leaders as well. Now, what I notice, my experience is the wiggles and jiggles of kind of groups and themes that are showing relative strength is getting quicker and quicker. Don't know why, it just is an observation of mine. So what you'll notice is there'll be areas of the market that are showing a lot of relative strength, and then they can just roll out of bed really quickly. They may show relative strength and build a base and trend for a week, a month, a year. It really depends on the context of the market. But what I'm then trying to do is try and identify, okay, where are the strong groups? Where are the strong themes in the market? Right now, that could be precious metal miners. It could be some commodity stocks. Okay, maybe it's kind of some semis and some AI related plays are showing strength. Then what are the leaders within those? So you want to see a strong theme or group, and then it's about trying to find the leaders within those. And what you tend to see is many applicable stocks within that group or theme are showing relative strength. Many applicable stocks are building bases and acting well as well. So this is the deep dive that we're going to go on over the next 3 weeks, this week included, and then the next 2 weeks. So let me start off with showing you some charts. And this session, we're going to focus on true market leaders, which we're going to give a significant weight to earnings. Okay, so earnings. I think it was either Ben Graham in The Intelligent Investor or Warren Buffett, I think, said it as well, that in the short term, there's my stutter. In the short term, the market is a voting machine, but in the long term, it's a weighing machine. What does that mean by weighing machine? It means the company's earnings. Now, of course, there's going to be wiggles and jiggles, right? If I just get the annotation tool up here, okay, there's going to be these wiggles and jiggles, okay, in terms of the share price. It's going to go up, it's going to go down, it's going to go up, it's going to go down, it's going to go up, it's going to go down, it's going to go up, it's going to go down, no matter how good the stock is. No stock goes in a straight line forever. If there was a stock that went in a straight line forever, we would all own it, right? Everybody would own it, okay? It's just not how the market, it's just not how it works. So there's going to be these wiggles and jiggles, okay, and this is where you're going to see relative strength come in, and then relative weakness come in, and a bit more relative strength come in. But in the end, a company is valued by its earnings. I think Davis said it really well as well. The quote, he said something along the lines as, it is earnings and estimates of future earnings, or expectations of future earnings, that really help propel a share price higher. So it is earnings and expectations of future earnings that really help propel a share price higher. And that links back into, obviously, Ben Graham, Warren Buffett, very different to Davis, of course. But in the short term, the market is a voting machine. In the long term, it's a weighing machine, meaning the earnings of the company are really what is going to drive stocks. So if you think about, why is Microsoft the size of Microsoft? Why is Nvidia now a 2 trillion market cap? Why is Apple the size of Apple? Why did Tesla get to the size of Tesla? Why is Amazon there? Why is Google? Ultimately, it's the company's earnings. There's going to be wiggles and jiggles, but the earnings and expectations of future earnings are really important. Like really important, especially when you're in TML type land, okay, true market leader line. So if you look at Microsoft, the line that I want you to try and focus on is this green line here. I've tried to dash it with this this green dash arrow, but you see how the earnings of Microsoft have gone from here to here. Okay, basically this green arrow. See that? How the EPS line, which is the earnings per share line, has basically done that. And what's the share price of the stock done? Well, there's been some wiggles and jiggles, haven't there? Okay, it's kind of ebbed and flowed, mean reverted a little bit around the EPS line, but it really is the EPS line, the earnings of the company, that is going to propel it forward. So it is earnings and expectations of future earnings that really propel the share price of companies. However, going back to that Ben Graham quote, in the short term, it's a voting machine. You can get things that just spike up for a couple of weeks or so, and it's kind of pump and dump, or the market thinks this is going to happen, and then it just rolls over. Maybe the market is expecting some important legislation to come through for a specific area. Maybe if we take like cannabis, it's legalizing cannabis in these states, these states, kind of nationally, or something like that, right? So cannabis stocks are like, oh, we're going to go. And then all of a sudden that legislation just gets pulled. And then what do you think they're going to do? They're going to roll over. But why did they rally? Well, it can be because of expectation of future earnings. Okay, they're going to legalize it. There's going to be a huge market, yada, 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 right? But you understanding my point, how the market is kind of how it kind of moves around the earnings and expectation of future earnings. So if we look at Tesla here, okay, so we don't just want a really strong EPS line, we also want the stock to be showing relative strength, which is going to be this blue line that you see here. You see this blue line, how it's just pointing up here? If I just kind of try and draw over it, because it's a little bit hidden, but you see this blue line here, this is going to be the relative strength line, okay, of Tesla. Okay, it's now pink line here, okay, but this is the relative strength line. And then take a look at the earnings line as well. You see that green line? Appreciate there's a few things going on, but look at the acceleration in the earnings per share of the company. Look at the acceleration in the relative strength. That's the real sweet spot. Okay, the EPS line is firing and the relative strength line is firing up as well. And then the stock goes and builds those classic kind of continuation type bases, flags, pennants, wedges, cup and handles, VCPs, ascending triangles, those kind of things, right? So it's a combination of things. And then there's the liquidity, there's the earnings, there's the sales, there's the estimate, there's the story, there's this new global product potentially available for the company, or a huge addressable market for the company as well. So it's a combination of things. So it's never just one thing, it's a combination of things. And we're trying to stack as many things as we possibly can together. But if you look here at the EPS line of Tesla, see the acceleration and then see how it just starts to roll over like this. And what is the share price done? Roll over like that. But the market will often discount it. Okay, you probably heard before that the market is a discounting mechanism. So it knows the future much more than we do, so it will discount the future. So if you take a look at NEO here, this is just an absolute textbook one, okay? So a really strong theme, okay, in 2020 and into early 2021, Q1 of 2021 being electric vehicles. This is when Tesla was rocking and rolling as well, okay? So what do we see? Well, the stock builds these multiple continuation type bases. It's trading this back in 2020, and it was some good times in 2020 trading NEO. And what do you notice about the EPS line? See this acceleration here. If I go and get this one here, see how I've tried to draw it with this arrow? See this acceleration. Again, the relative strength line, it's actually hidden. It's kind of there with the share price, but it's really ticking up as well. So we have a really strong earnings growth coming through this company, ridiculously good relative strength, lots of liquidity, high DR. This is a momentum leader type stock, and the earnings are accelerating in terms of the EPS line. And then take a look here. Well, what happened to the EPS line? You see it? See, it just rolls over. What does the company share price do? It rolls over. Okay, so it's not just one thing moving it, but you want to be aware of the earnings, certainly of these more like TMLE type stocks. Let me just do a couple of examples to really try and explain it. So we're going to take a close look at NVIDIA in a couple of minutes' time. But if you look at NVIDIA, okay, when is NVIDIA, and we can talk about it most recently as well. If you look at the EPS line, it's really accelerated, okay, from here up to here. Note the acceleration in the EPS line. And what's the share price done? Pretty similar in terms of the earnings being propelled. And we're going to take a real deep dive in NVIDIA. But remember what I said earlier, the Darvis quote, it is earnings and expectations of future earnings that really propel a share price higher. So when you see this sudden uptick in earnings coming through for the company, and suddenly, whoa, hang on a minute, the company said they were going to report this, and now they've just reported this, the market will adapt to that information. Sometimes you can see earnings gap ups. The company was like, well, we were not expecting that. Maybe the company said, actually, we're going to raise our full year guidance from $1 per share, so the EPS, to $2 or $3, and the market's like, whoa. And then there's potentially a massive gap up as the market reacts to the new information. The market is the most Bayesian thing out there. So if you see when NVIDIA is really rocking and rolling here in terms of the share price go, what do you notice the EPS line is doing? See the correlation? It's not a perfect correlation, and the market will often top ahead of the earnings. So if you look at when the EPS, the earnings per share, top for NVIDIA, see how the market topped a few months beforehand? So the market is a discounting mechanism. If we zoom, I think Zoom is maybe the next one. Let's go have a look, see if I got Zoom. Oh, SMCI, really good one in terms of the acceleration of the EPS line. I'm going to show you how to get an EPS line on TradingView in a few minutes time as well, 10 minutes time. See the acceleration? So again, if you think about this here, we'll just spend a little bit of time on this. SMCI went from, let's say, $30, $40 to $1,000 per share. Think about that. Why did SMCI go from $30 per share to $1,000 per share in 2 years? Like, why? Why did the stock do that? And if you take a look at the EPS line here, see the significant acceleration in the earnings per share of this company. So it is earnings and expectations of future earnings that really propel the share price higher. So you want to be aware of this stuff. So the EPS line, the earnings of the company, the expectations of future earnings of the company are important, as is the relative strength line, as is the technical strength, yada yada yada. Right, the stuff we'll come on to in a little bit. Let me go on to the next one. So this is going to be Zoom as well. So we're using Zoom right now, and many of you are probably using Zoom in 2020 as well. So if you look at Zoom, what happened to Zoom during 2020 and into 2021? Well, if you take a look at the earnings per share line, see the acceleration, okay, from down here up to here. See that huge acceleration in terms of the earnings per share. Look at the relative strength line here. See how it's just mega. Like Zoom was one of the strongest stocks during that time. So again, if you think about Zoom, how did Zoom go from $60 to nearly $600 in 9 months? Like, how does a company 10x of Zoom size, how does it go from $60 to $600 in circa 9 months? Like, what happens? Well, the world was basically shut down because of a global pandemic, and a lot of people started using Zoom. So what did that do for their earnings? Earnings and expectations of future earnings. But then the market looks at things in terms of, are things getting better? So the market doesn't think in terms of things are good and they're going to stay good. The market doesn't think in terms like that. How the market thinks is, are things getting better or are things getting worse? Or are things just going to stay the same? So are things getting better or are things going to get worse? So if you look at Zoom, right, the earnings peaked. So the stock tops a couple of quarters before the earnings peak. So when the earnings are coming through, I appreciate it's a bit hard to see, but the earnings are up 500%, 999%, 999%. And then Zoom tops, while the earnings per share on a year-over-year basis are 700%, 500%, 46%, 12%, 6%. And then it goes into negative year-over-year, 22, minus 22, minus 23, minus 4, minus 5. Zoom is a fascinating one to study. The market topped when earnings were at their peak. Zoom topped while earnings were at its peak. Why? Because things weren't going to get any better. Things were going to stay pretty good in terms of the earnings, but they were going to start slowing down and slowing down quite significantly on a year-over-year basis. So on a rate of change basis. So are things getting better and expected to get better, or are things expected to get worse and slow down? So rate of change in terms of the acceleration of earnings and sales growth, but also the rate of change in terms of declining earnings and the declining sales on a year-over-year basis. So sometimes you can see the market just starts going and you're like, well, hang on a minute. The quarterly earnings are, so if I go forward one more now onto NVIDIA like this. Okay, so if we go forward onto NVIDIA, when NVIDIA started going, so this is then quite interesting as well. Okay, the market again is a discounting mechanism. So if you look here, when NVIDIA bottoms, earnings are down year over year, 51%. So it's going to be these figures here. Okay, NVIDIA's earnings are down minus 51%, minus 50%, minus 33%, minus 20%. But what's happening? Look at this relative strength line. See how the relative strength line is turning up? Like the market just has this uncanny ability to know the future. And whether it does or doesn't know the future, it's the reality that the old saying, price is king. You just got to go with what the market currently thinks. The market can change its mind. It often does. It often does change its mind. But here you can see NVIDIA starts its real rally turning off the bottom here, but earnings on a year-over-year basis. So being reported on a quarterly basis, but these are year-over-year. Year-over-year, earnings are down 51%, 50%, 33%, 20%. Sales are down 17%, 21%, 13%. And then look what happens. 429%, 593%, 483%. Next earnings are expected to come in at 473% year over year. Sales going from 8 billion on a quarterly basis, expected to go to 13 billion, 18 billion, 22 billion, 24 billion. So what has really propelled NVIDIA from around $100 to $1,000? Earnings and expectations of future earnings. So the things that I pay most attention to okay, are going to be the annual EPS with TML, so true market leaders. I like to see it into all-time high territory, and ideally the estimates are in all-time high territory, and the forward guidance, which are these little green arrows that you see here on market surge charts, that is forward guidance has been raised. Really, really, really good. In terms of the quarterly EPS and the quarterly sales, it's the same. All-time high territory is really good. Rate of change is important. So if you look at NVIDIA, it's reporting 50 cents, 50 cents, 80 cents, $1, $2, $4, $5. Whoa, that's an acceleration. Same exercise for the sales as well. 8 billion up to 22 billion. Think about that. Quarterly sales have gone from 8 billion, well, 5 billion, 5.9 billion to 22.1 billion. Has there ever been another publicly traded company that's done that in that span of time? I could not name. It's gone from 5.9 billion in terms of quarterly sales, and then 5 quarters later, 22.1 billion. Couldn't name them. So this is why NVIDIA's done that. Expectations, future earnings. Earnings and expectations, future earnings, really, really, really important. Then, of course, we're looking at relative strength. We're looking at the bases. Okay, we're doing all the things that we do in the in terms of what we did in the prior 3 weeks in terms of gap down, reverse bars, shakeout, demand tails, trigger bars, around the key moving averages, so the type of setups. But now it's about taking that knowledge in terms of the type of setups, and then it's the type of stocks that you're looking for those setups on. For me, it's not a biotech company with a 50 million market cap. For me, it's not some UK AIM listed stock that's drilling off the north coast of somewhere, and they found this massive oil reserve, but they've got no money, and their market cap is 10 million, and the spreads are 5% wide. So to get in and out, you're paying a round trip of 10% or something like that, and there's just no liquidity, and it's just absolutely panned. And they got one drill to get it, but if they don't, the company's just bankrupt. Like, you may see a gap down reverse bar on the 21-day EMA in that little micro cap company, oil and gas company drilling off the north coast of somewhere, but it's, for me, it's completely the wrong stock. So it's the type of setups, but then what is really, really important is the type of stock. Really important. So we now go and do a couple. So let me just clear all of that. If any of you guys want to join in, just let me know. Otherwise, I'm happy to rock and roll by myself. So let's go and load a couple of things up. So let's start with this one here. Okay, so this is FTI. So this one here, tried not to just cherry pick them. This one here, I was targeting this heading on this session, so heading through on the next day. What I've tried to do is, let me just see if I can adjust it. I want to try and show you that figure there, 2.84%. So here we go, right? So you're looking at this is where we go much more so into the tactile stuff, okay? So it's about, okay, having an understanding of the type of setups, okay? And I would suggest go study thousands of charts and see what you see. What do you see continues to repeat in terms of the characteristics? What do you tend to notice? Does the stock rally like this? Does it pull back like that? What are the type of candlesticks you see? Does it happen around a moving average? Where do you think is the best place to be getting in terms of being able to identify a repeatable setup, in terms of controlling the risk? So it's asymmetric in nature. How do you then mitigate the risk? Then from that type of setup, what do you expect to happen? Because that feeds into your selling rules and your selling guidelines for how you're looking to optimize profits. And then it's about learning there's different types of stocks in the market. All stocks are different. Every single stock is unique. Okay, maybe kind of themes in the market, strength in the market in terms of specific groups, but each stock is unique. So now we're getting to the point where, okay, you know the type of setup that you're looking for, you know the type of stocks that you're looking for on, but then let's go for an example here with oil and gas stocks. So on the top, we have FTI. On the bottom, we have ExxonMobil. So if you were just looking at this, you'd go, well, FTI, that's kind of like a shakeout demand tail. I appreciate it may be a little bit small, but I've tried to get these charts on here, plus the EPS dashboard. And by the way, once this loads, this one here, earnings, sales, and volume dashboard is this one here that I'm using. Tweak the settings of it a little bit, but you can see here, right? It's an inside bar sitting on the 1021, so it's trigger bar S, but also a shakeout demand tail, right? And the volume is dried up quite nicely. Then we could go and look at ExxonMobil and go, well, to shake out demand tail off the 50-day, that's a good setup, isn't it? Shake out demand tail, first retest of the 50-day. Well, it may be a good setup, it may not be a good setup. Is it showing relative strength versus the market or the group? And or the group? and its individual peers. So then it's about trying to decide, okay, what's the best setup that you can be targeting heading into the next session? And sometimes you reach the conclusion that there is no good setup to target heading into the session. And that's also a fine decision to reach. But I'm going to take you through the thought process that I go through. So one of the things that I'd go through is, what is the technical strength of the stock? So this is where I just default to the market and I go, okay, Mr. Market, relative strength. It's not my opinion. It's not John's opinion. It's not Bob's opinion. It's not Suzanne's opinion. It's your opinion. What's your opinion of the strongest stocks in the market right now? Because my observation is the strongest stocks invariably, it can wiggle and jiggle a little bit, but invariably will show the greatest amount of relative strength. So you can think about that in terms of the relative strength line. You can also look at it with your eyes here, and you can go, okay, FTI is here around its 10 and 21 day, whereas ExxonMobil is down here at its 50 day. Why is one stock setting up with a shakeout demand tail off its 50 day, whereas the other one is holding above its 10 and 21? Which stock is stronger from a technical perspective? FTI, right? Must be. If you look at ExxonMobil, lower low, lower high, lower low down here. You look at FTI, okay, lower low, kind of matches, puts in a higher low, and holds around the 10.21. So this is then kind of a lot more tactile stuff, but it's what trading is. When you're planning, preparing for the next session, this is what I do on a daily basis. You're planning and preparing, and you're trying to make the decision, okay, oil and gas stocks are showing strength. Do I want to go ExxonMobil, shake out off the 50 day? Do I want to go FTI? Well, FTI, we've already reached a conclusion. Technically, is showing more strength. We can also think about, just as we're on the technical side of things, where we transition to the fundamentals, is we can also think, you can see the relative strength line is stronger as well. It's a little bit difficult, but the RS line is better. You can also think about the initial stop loss, which in this case here, through the high stop underneath the low, assuming perfect execution for both, which of course is rare, is 1.5%. Now we can think about that 1.5% relative to the stock's 20-day ADR percentage, which in this instance, a little bit hard to see, appreciate that, is 2.84%. So what does that mean? Well, that means the average daily range percentage of the stock, excluding gaps, is 2.84%. So over the last 20 days, the average range of the stock from high to low is 2.84%, excluding gaps. So what does that do? Well, it gives you a feel for the quickness of the stock, right? It's reasonable to expect the stock can move 2.84% on a day, because that's what it's done over the last 20 days. So this is why it's then useful to think about initial stop loss relative to 20-day ADR percentages. I'm not of the view just going in with all stocks of a 8% initial stop, 7 to 8% is prudent. I don't think it is prudent at all. Then when you look down here, so if we're going 1.5% off a 20-day ADR percentage of 2.84%, that's pretty good. Half to 2/3 is pretty good. Shakeout to martels, gap down verse bars can be around the 20-day ADR percentage. I try and keep it sub 4%. That's what I try and do myself. If it's really good and it's within like 1.5 and my initial stop loss is sub 5%, I'll still think about it. But ExxonMobil, 1.67% would be the initial stop, assuming perfect execution through the high stop underneath the low. And the 20-day ADR percentage is nearly 1% slower, 1.86%. So when you think about it as a metric, in terms of the initial stop loss relative to the 20-day ADR percentage, FTI is much more favorable. So from a technical standpoint, it's stronger. High low, 10.21, whereas ExxonMobil, low to the 50-day. Now, is it good for FTI, ExxonMobil? You've got to know the stocks in the group as well. ExxonMobil is one of the big boys. Is it constructive to see one of the big boys putting in a nice shakeout demand tail off the 50-day moving average? Absolutely. But in this instance here, FTI is a better setup from a technical standpoint and an initial risk standpoint. Then we can bring in the fundamentals. So if we take a look at FTI, appreciate these figures are going to be a little bit small for you, okay? But if we just look over the last 2 quarters, okay? FTI in Feb 2024 reported earnings per share of 14 cents, which year over year were up 367%. ExxonMobil in February 2024 reported earnings per share of $2.48, but year over year, that's down 27%. So do you want to be year over year, a company's just grown its earnings 367%, or do you want a company that's down 27% year over year? Who's winning so far? FTI is winning so far. Then we look at the most recently reported quarter being April. So FTI reported 22 cents per share, which is an increase year over year of 540%. They've just grown their earnings over the course of a year. So that's year over year, Y over Y, 540%. ExxonMobil, on the other hand, year over year is down 27%. So do you want a company with triple digits earnings growth, or do you want a company that's down 27%, 27%? on the face of it, you want the company with triple-digit earnings. If we then take a look at the sales growth, FTI is up 20%, 20% in the last 2 quarters, year over year, whereas ExxonMobil is down 12%, 2%. Which one do you want? So when you look at the face of the fundamentals here, this is how we kind of piece it all together, right? There's a lot of parts. It's not easy. If you're expecting it to be easy, don't. It's not easy. You have to maintain a lot of information in your head. Okay, you can't write all of this stuff down. You've got to be able to keep it in your head and just assimilate information and then try and make high quality decisions with that information. They have to be really switched on to be a trader. It's not easy to do this. So what do we think is better from a fundamental perspective in terms of earnings, in terms of sales growth? FTI. So at the minute we're going FTI is stronger technically for all the reasons we discussed. It's a better setup in terms of the initial risk relative to the 20-day ADR percentage. Also a tighter stop than ExxonMobil as well, 1.5 versus 1.67. Fundamentals, earnings and sales, growth looks much better for FTI. Then what we can do is start thinking about liquidity. Don't worry about this up down thing. It's nonsense basically. But I just want to keep the ADV and the average dollar volume. So the ADV is the average daily volume, which is 4.72 million shares, but this one here is going to be more important, which is the average dollar volume for FTI is going to be $122 million worth of stock is exchanged on a daily basis. I don't know how far back that goes. It's pretty close to what we have on stocks for the last 50 days. Better if it said like ADV 50 or something like that for this one, but it's what it is. Whereas ExxonMobil is more liquid. $2 billion worth of stock is traded per day. This is why I said anything over 100 million is kind of okay. I would say that means it's going to be pretty liquid, anything with an ADV average daily dollar volume of over 100 million. So it's kind of fun. So I would say on the face of it, FTI is much better. We can also then zoom out. So we just looked really close here. Let's zoom out. Just set this up. Put it back like that. Fit. Now we can look here, okay? Let's keep going back. Let's go to, let's say here, right? Another exercise that I like to do is if we go and take the peak high from, well, let's do it when ExxonMobil topped out here. 28th of September, 2020. Oh, my birthday. Interesting. 28th of September. There we go. Okay. So this is something else that I like to do. If you think about ExxonMobil, let's just put them across here like this. Why is FTI up here? Big high. Why is ExxonMobil down here? It's not even been able to clear its November, or its Q3, Q4 high in 2023. Like, it's here. Whereas FTI is up here. Again, this is in the technical strength. What stock is stronger? 52-week highs, 52-week lows. So this is about trying to assimilate all the information and then try and make a high quality decision with that information. So for me, I then think FTI is the better one. If we then play it forward, this one I was targeting, didn't get filled on this one, but it is what it is. So ExxonMobil is still kind of then languishing down here, whereas FTI still looks a lot stronger than it. We're going to do another one. I'll take you through Raytheon. So Raytheon is one that I targeted today. Assuming I haven't been stopped out of it. Let me go have a look. No, I haven't been stopped out of it. So still in this one at the time of filming this video. So you have Lockheed Martin on the top. You have RTX Raytheon on the bottom. So this is the exercise I was doing yesterday for today's session. If we just start with the technical strength, right? If we look at Raytheon, if we go from the Jan 16 level, okay? So let's go from here, Jan 16. What do we do there? 16th of Jan. There we go. Okay. Why is Lockheed Martin? If we just zoom this in, pull it across, zoom this in, pull it across. Why is Lockheed Martin just underneath it? Whereas its brother sister stock, RTX, is up here. Which one is stronger? Like from a technical perspective, which one is the market telling you this one is stronger? It's Raytheon, RTX on the bottom, right? Look at the 52-week lows for Lockheed Martin as well. Now, Raytheon's not hitting 52-week highs, but look at this RS line trending up, because it's just pretty flat. So you may look at this, and then if we just zoom in more, okay, so big picture technicals, Raytheon, a lot stronger. If we now start zooming in, so now we start going more tactile with it, okay? So we start looking here. If you're just looking at Lockheed Martin, Again, you didn't have the context and the awareness of the brother-sister stocks and the overall strength relative to the market as well. So if you're just looking at Lockheed Martin in isolation, that's why I don't like looking at things in isolation. When I'm running my screens, I will group them together in terms of industry groups. It's really, really key. If you're just looking at Lockheed Martin here, you may go, well, nice shakeout demand tail off the 21. Heard a lot of good things about that. Gap down reverse bar off the 21. Now look, it's like this tight little shakeout demand tail, trigger bar S. The volume is dried up. Okay. But if you look at the brother-sister stock below, in Raytheon, look at this. Gap up, and look how it's just held the 10, held the 10, held the 10. So why when Lockheed Martin was down here, around its 1021, gap down reverse bar under its 21, RTX is way above it. Why is that? Again, it's strength. It's the market telling you this is the strongest stock. Then what we can start doing is looking at the fundamentals. So again, it's in the same exercise. You can start looking at it, and you can look at the EPS that's being reported. You can look at the sales that's being reported as well. I would say Raytheon is better there. I'd say it has better liquidity as well. But it's really the relative strength of this stock and the technical strength. And then what we can do as well is if we zoom right in like this, if I just pull these down, then what you can do as well is you can think about initial stop loss relative to the 20-day ADR percentage. So with Raytheon on the bottom here, it's 0.43% off an ADR of, or relative to an ADR of 1.52%. It is less than a third, like textbook trigger bar off this shakeout demand tail off the 21. Whereas Lockheed Martin is about half, 0.72%, which is still a tight stop, off a 20-day ADR percentage of 1.48%. So one is half, the other is a third. Which one is more favorable? So this is where you start piecing all the proverbial pieces of the jigsaw puzzle together. So for me, I went for Lockheed Martin. Sorry, I went for Raytheon, and sometimes they work, sometimes they don't work. But it's the point of understanding, how did you reach the decision? How did you get there? And what were the inputs? So with trading, you really want to think about systems, routines, inputs, outputs. You want to think about the inputs that you're putting into your trading. Okay, we're obviously spending a tremendous amount of time on the identification because there's a lot that goes into the identification. It's like the bedrock, right? Okay, it's like a house, location, location, location. The setup, identify, identify, identify. You've got to start from a strong base in terms of how are you looking to identify a setup? What are your inputs? If you show me the inputs that you're putting into your identification, I can not predict what your next 100 trades is going to look like, but I have a good idea. So you want to get really good at thinking about systems, inputs. What are the inputs that I'm putting into my identification? Why did you go for RTX over LMT on this day here when both brother-sister stocks were setting up? Like, this is the depth that you want to go into. And if it's semiconductor stock ABC versus XYZ, well, why did you go for that stock ahead of that stock? And you should know the answer to it. Well, the reason I went for this stock ahead of this stock is because of A, B, C, D, E, F, G. I don't even know the alphabet, such as the nature of being dyslexic. But that's the depth that you want to go into. Really understand it. Okay, why was I identifying? Why were these the inputs that I put in? Why did I go for RTX head of LMT? And it's okay to make mistakes. It's absolutely okay to make mistakes. I make 101 of them every year. I go for this stock when I should have gone for this stock. I didn't go for that stock and I went for that stock. I should have gone for that stock. Then I go back and I review it. Well, why did I go? Fortunately, I film all the like weekday videos, right? So for me, I can kind of go back and review it and be like, okay, on that day when that stock broke out, why was I not targeting that stock? And if it's because, well, actually, you were targeting 3 other stocks and you thought at that moment in time they looked a lot stronger, that's kind of okay. But maybe I made a mistake in my analysis, and actually I shouldn't target that stock. I should have targeted that stock. That was the leader. That was the stronger group. I should have gone for that one. And I try and learn from that. The reason I know about this stuff is because I made 101 mistakes not doing that stuff. Let me go and show you another one. If you guys have any questions, then please do just ask. So this is something. Let me take you through. We may finish with this one. I don't want to labor the points. Don't want to labor the point too much. That stock there, MOD, is very strong, isn't it? Interesting. That's interesting. So these are on the final day. So we're filming this on the 7th of May. So these are on the final day. Now, both of these are precious metal miner stocks. So I'm going to take you through the exercise. So imagine that they close like this tonight. So this is the exercise that I will go through as the market closes, and I will go through and go, okay, which one do I want to target? Let's imagine that they both close similar to how they look now. So we've got HMY on the top and we've got PAS on the bottom, Pan American Silver, both precious metal miners. So if we look at the technical perspective first and foremost, well, one has an ADR of 4.03% HMY, whereas PAS has an ADR of 3.75%. Okay, both are reasonably quick. HMY, a little bit quicker. Okay, interesting. Initial stop loss, 1.58% off an ADR of 4.03%. Favorable? I'd say it's pretty favorable in terms of the initial risk, under half. Same with PAS. It's actually nearly a third, isn't it? Nearly a third. So PAS is actually more favorable in terms of the initial stop loss if you're thinking about it a metric relative to the 20-day ADR percentage. Okay, interesting. What do we prefer in terms of the technical setup? Well, HMY undercut is 10 and 21 there, whereas PAS was able to just hold on it. PAS is winning right there. PAS is also sitting just above its 10-day, whereas HMY has pulled back to its 10 and 21. PAS is winning there. However, PAS has earnings tomorrow. So earnings and proximity to earnings creates complexity in terms of a trade management. Can also create complexity in terms of brother-sister stocks and how they react to it. So if you imagine, let's say you have AMD and you're looking at AMD and you're like, wow, AMD, it's not right now. But imagine if you're like, wow, AMD looks really, really constructive, looks like it's kind of setting up nicely, but Nvidia is reporting tomorrow. If Nvidia has like a blowout earnings report, right, it's probably going to drag AMD with it. If Nvidia just gets absolutely smashed and they lower forward guidance for the year and it just gaps down 10%, 15%, what do you think AMD is going to do? Well, it's probably going to do the same. So you've got to be aware of the type of stocks that are reporting within the brother sister stock or within the group, within the theme, and how they may or may not affect stocks that you're looking to purchase. So again, it's not just awareness of the stock that you're looking to purchase, it's awareness of the other stocks within the group. Do they have earnings coming up? Do they not have earnings coming out? What were recent earnings reactions? Were they positive? Were they not positive? Did you see a positive reaction? Did you not see a positive reaction? Or does that potentially tell you about how large operators are treating the group? You seeing accumulation signs? Are you seeing distributional signs? There's a lot to be thinking about. If we then go into the fundamentals, actually, if we just zoom out here, I just want to zoom out and go really big picture, okay? Because on the face of it, the technicals there look a lot better. Not a lot better, but they look better for PAS over HMY. But why is HMY all the way up here? Why is it all the way up here? Whereas PAS, from that same high of April 2023, is basically level. Why is HMY 67% above that level and PAS is basically flat? Why is one hitting 52-week lows and the other's hitting 52-week highs? So this is where we get into the complexity of things, right? Because if you just zoomed in as we were just zooming in, you probably went, PAS looks better. But when you zoom out, now it looks better. So we don't trade in black and white. We trade in areas of grey, shades of grey. So now when you look at it, are you now reaching the conclusion, well, PAS is stronger from a technical standpoint? Or are you reaching the conclusion, no, HMY is stronger from a technical standpoint? Some of you may think HMY, the others may think, actually, it's PAS. I would say HMY because it's so much higher up relative to these highs. Like it's already broken out. It's already in a clear kind of phase to uptrend. Just longer relative to PAS. PAS had a really good rally, but I think HMY is stronger for those reasons. Now, if we go and zoom in here again, and we start bringing in the fundamentals. So we now look at the fundamental side of things. We'll look at the last two quarters. So earnings. I'll need to go get market search up. This dashboard doesn't work really well. So if we look at HMY, earnings are up 205%, 205%, sales are up 26%, 26%. And the estimates are for this year up 148%, forward guidance up 28%, forward guidance up to 2025. And see how it's broken out of here, RS line, EPS line, turning up pretty nicely, right? Look at the volume coming through. Nice, we like that. If we go look at PAS, what do you have? Well, earnings were up 700%, then they were down 100%, and the sales growth pretty good, 82%, 78%. EPS estimates this year, 242% forward guidance up. Next year, 51% forward guidance down. So on the face of it, some of it's the sales growth is better, but I would say the earnings growth is not as good. Look at the earnings growth, look at the sales growth, look at the EPS estimates. Then if you go to PAS, the sales growth is better, but the earnings aren't. And then see how it's just way off the highs here? See that? And then HNY, it's above the highs. Look at how HNY is above the highs, whereas pass way off the highs. Why is one stock above its highs? Whereas another stock, if we go on to, say, the monthly chart, see what's down here? Whereas HNY is acting a lot better. It's a lot closer to these previous highs. So I would default to the relative strength in the market and go, HNY looks the better candidate. We can then also go and get a feel for how the stock moves. So this is then also an important consideration, is zoom out and look for the type of setups that you like looking for. So you want to go and then get a feel for the stock and go, okay, when this stock wants to move, this stock can really move. This stock can really move. Pass. Okay, kind of moves pretty well in there. Here, there's some decent trends in here as well. So, okay, it's a pretty good mover. But you can see what I mean by there is very rarely a clear-cut answer. You have to do a lot of thinking. Like, you actually have to think about it. You go, okay, if I want to target a precious metal miner, do I just want to target one? Do I want to target two? Do I want to target three? If I do want to target three, why do I want to target three? What do I think are potentially the one or two real leaders of the precious metal miners? There will always be leadership, whether that's semiconductors and Nvidia, whether it's EV stocks and Tesla, whatever it may be, there'll be leadership within the group. There'll be the couple of standout stocks within the group. And this is kind of the exercise that you go through, I think, to try and identify, okay, the group is showing strength. What are the leaders within the group? What are the TMLs? What are the ones with the best earnings, with the best sales growth, potentially with the best product, with the best estimates? Then look at relative strength. What does the market think is the best stock within that group? The best stocks often display the greatest amount of relative strength. So what does the market think? There's a reason why HNY is all the way up there, whereas PASS is like still down here, right? Now, maybe you reach the conclusion that, well, one's a gold miner, one's a silver miner. You're expecting silver to actually go on a much bigger rally than gold. Maybe, maybe not. The market will prove you right or not. Time will tell. But for you to then reach a conclusion of this is why I'm targeting this stock heading into this day, there's a lot of work, a lot of thinking that goes into it, both in terms of the technical aspect of things. So the quality of the setup, the initial risk. What do you think? How easily can the risk be mitigated? How quick is the stock relative to, say, the 20-day ADR percentage? When you look back at the stock here, what's the character for the stock? Is it just choppy, choppy, choppy? So it just does this and it just chops all over the place, or is it actually, no, that's a nice move above the 10, above the 21, stays above the 50. That's nice. That can optimize the profits there better relative to past doesn't. But if the other stock just did this, I think we have our answer, right? So going back and study, understanding the character, and then we bring the fundamentals in, the earnings, the sales, the estimates, yada, yada, yada. Are they high quality funds? Are they not? What's the dollar volume? How quick is it? All of that stuff. So there's quite a bit that goes into it. So I won't labor the point anymore. Hopefully that gives you a really good kind of feeling for TML type stocks, the kind of thinking that I think one has to do in terms of a trader planning, preparing for the next session, because oftentimes you will see a lot of stocks from the same group setting up, heading into the session. And then it's about working through your process, thinking about how you identify, thinking about what it is you give significant weight to, and then making a decision. And then owning the decision, going, this is why I did what I did when I did it. But clearly understanding your inputs for why you reach that decision. So if we understand the inputs, we can improve the inputs. It was a skill-based exercise. So I'll wrap it up there, guys. Hopefully you enjoyed that session. Next week, we'll do momentum leaders and we'll go and get a couple of quick ones. And if any of you guys next week want to join in with some bar by bar stuff, and we'll go do some high 20-day ADR percentage stocks, that could be a little fun. So yeah, thank you very much for watching. Hopefully that was useful, and I will see you in the next webinar. Hey guys, hope you and the families are well. This is the live coaching session for May 14th, 2024. So this one is the blueprint course, and what we're going to be doing is following on from the prior session, which was on true market leaders. We're now going to do momentum leaders. So I try and categorize stocks into three main categories: TMLs, momentum leaders, and group theme leaders. So today I'm going to be explaining all about momentum leaders, which there's a couple setting up at this moment in time or developing basis, which is quite interesting. So go down here, we'll just do a very quick recap of last week. So I was giving you the outline of true market leaders. So this is what I look for in terms of momentum leader type stocks. Stock doesn't have to have all of these things, but the more the better, generally speaking. So a high 20-day average daily range percentage, which means that average daily range of the candlestick from low to high ideally is 3 times that of the major indexes. If you keep in your head, SPYs, triple Qs is around about 1%. It ebbs and flows, but keep in your head around 1%. So I'm looking for something something that ideally has a 20-day ADR percentage with momentum leader type stocks of greater than three times that. So 3%, 4%. Ideally, though, it can be 5%, 6%, 8%, 10% and above. That's obviously going to affect things when we start thinking about controlling risk. Why? Because the volatility of the stock is greater. So when we start going bar by bar in a little bit, if anyone want to join in with that, then please just let me know in the chat. Otherwise, I'll rock and roll by myself. The liquidity on a 50-day dollar volume basis is greater than 100 million. I put 100 million there. Oftentimes it can be much higher. It can be a couple 100 million, 500 million, a billion for some of the real kind of tier one type momentum lead type stocks. But 50 million, 100 million is probably going to be the lower end of that. This is going to be a discretionary exercise. It trends and moves well for traders. I'm going to show you a couple of charts in a few minutes time to explain this point. But we're really thinking through things when we analyze the character of the stock from number one, identifying the type of setups that this stock likes to form. Are they the type of setups we like to target? Thinking about the controlling the risk mitigation, and the optimizing profits. That's then thinking about, so the first part and the last part, the identification. Does the stock set up how we'd like it to set up? Trigger bars, shakeout demand tails, gap down reverse bars, continuation type basis around one or more key moving averages, 10-day, 21 days, and how does it trend thereafter? That's obviously going to be a discretionary exercise. Short-term high relative strengths. Oftentimes you can just see, wow, this thing has just popped up 50%, hundreds of percent, and then it starts basing. It did it on huge volume as well. So we'll talk about that. Sometimes it can be a polarizing company and or story. Most notably a couple of years ago, like Tesla, Elon Musk, fairly polarizing company. Sometimes it can be like PLTR, Planeteer. So it could also have a high short interest. Sometimes those things can go hand in hand as well with being polarizing. Some people just love to hate things. Don't know why, but some people just do. So sometimes you can see that, well, it's a really polarizing company and it has a high short interest. For me, I'd characterize that as greater than 20%. When you start getting greater than 30%, that's very high. When you start getting 40% and above, that is very, very high indeed. So these are the type of things that I look for in terms of momentum leaders. Maybe 10 minutes or so, I'll show you how you can run a couple of quick scans in stocks for an area to identify these kind of setups. So let me just take you through a couple of charts, and I just want to highlight some of those main points. So don't worry, we're not diving in here. This is just broader view, just giving you an overview of things. So a lot of times when you're looking at any stock, whether it be a TML, momentum leader, group theme leader, I think you want to try and get a feel for the stock. What's the best way to get a feel for the stock? It's not listening to what John is saying on Twitter or Joe Blogs is saying on CNBC. It's actually looking at the chart. It's actually taking a look and going, okay, how does this stock wiggle and jiggle? How does it move from proverbial point A to point B? If I just get the annotation tool out, like how does Tesla like to move? So when it goes from point A down here, so basically being the start of the trend, to point B being the top of the trend, how does it do it? When Tesla goes up 450 odd percent, how does it do it? So this is how you have your process and you have your framework, and you think about, okay, how do I like to identify setups? What am I looking for? You should know very clearly, okay, what is it that I'm looking for? Like, what is it that makes me go, yes, this is a setup I want to target? And it shouldn't just be, well, I saw this YouTube video and the CEO was talking about this, or some guy on the internet said that this is going to happen and the company is going to do this and he values it at $1,000. Like, hopefully you're a little bit more detailed than that, and you're going, okay, I like to see this happen, that happen, that happen, that happen, and then that leads to that, and then I do that, and I think about things this way. So then we think about the identification, we think about the controlling risk, the risk mitigation, and then the optimizing profits. So for me, I'm trying to get a feel for the stock and go, okay, how does Tesla like to go from point A, being the start of a trend, to point B when it tops out? Because nothing trends in a straight line forever. Hopefully a chart of Tesla will show you that. It doesn't matter how balled up on the company you may have been or your friends may have been, things do not run in a straight line forever. They just don't. Okay, they wiggle and jiggle. They build bases, they trend up. It's the price cycle. It's the foundation we started with. What I see stocks do is they build phase one accumulation bases. They go in phase two uptrends. They have phase three distribution tops, phase four downtrends. And the cycle just continues to repeat. It's just the cyclical nature of how these things move. But what we want to do is then go, okay, when Tesla goes on a run and it goes up 450%, it goes up 250%, how does it do it? What is going to be optimal in terms of selling rules, selling guidelines for you? Is it 10-day EMA as a trading stop? Is it 21? Is it 50? Is it 200-day? Can you tolerate pullbacks to the 50-day and give up potentially 40% in these momentum leader type stocks? Can you not? Is it a combination of things? So this is where it's never a one size fits all. It's about having a very, very good toolbox, a useful toolbox for your framework, and going, okay, this is how I identify, this is how I control, this is how I mitigate, this is how I optimize, but it can be adaptable based on the character of the stock as you see it. And then you can go, okay, for optimizing profits on Tesla, I actually think it's better to use a combination of the 10-day and the 21-day EMA. Whereas on Nvidia, I actually think it's going to be better to use the 21 and the 50. So that's how you just tweak things from a systems level, inputs, outputs, inputs, outputs, but you go into your systems. So it's very important when you're looking at these momentum leader type stocks, they are going to move differently to your Apples and your Microsofts and your Googles of the world. Okay, these ones move differently. They're more volatile. They're much quicker, as you're going to see with the ADR percentage when we get into the bar by bar stuff. If we just go through a couple of charts, right? So PLTR, these are ones that I'm then looking back at and thinking, okay, if PLTR sets in the future, I've got to be aware of, okay, how does this stock move? When it breaks out, how does it want to break out? So you'll see that there's slower stocks in the market. So like a Microsoft is not going to build out from an IPO base because it IPO decades and decades and decades ago and run up nearly 200%. It's just not going to do it. It's just not that type of stock. So all stocks are differently. So we want to think about stocks differently. So when I look back at a stock, I'm going, okay, I bought it back down here in the good old days of 2020. How did this stock go up nearly a couple 100%? What did it do? The 10-day, 21-day. Okay, here it kind of went really quickly and then potentially going lower the bar would have been better because it then rolled over really hard over here. Okay, from here it's in this phase one base if I go get the annotation tool. So it's obviously little phase one base here, the IPO base runs up. So this is phase two. And then you have this big phase three top in here and then it goes down. And then this is your phase four downtrend. So again, we're contextualizing where do we think it is in the context of its price cycle. Then here it builds a big phase one base, starts running out. So it's early in the context. So 2E, it's early in the context of phase two. Good earnings reaction in there, and then power's high about 70%. I'm not saying you're going to top tick it, but if PLTR sets in 2 weeks' time, a month's time, a couple of years' time, I want to be aware of all of this. I want to be aware of the characteristics. Okay, how does it move? Is it 10-day, 21-day? Is it the 50-day? If it starts getting really extended, do I want to choke some off? It seems pretty prudent with this stock here. So these are things that you want to be aware of. Let me take you through a couple of more just to illustrate the point. Here we go. We're on to the next one. So like a Coinbase here, right? So this one, I didn't get filled on this one. I'm still irritated about this one here. But when you're thinking about a Coinbase, let me just pull this up here. It's got a 20-day ADR percentage. Let's imagine when it's setting here, it builds this cup and handle, shake out demand tail off the 10-day EMA, and it's got a 20-day average daily range percentage of 7.4%. What does that mean? If you take the average daily range of the candlestick, so from the lower the candle bar, if I just do a really bad candlestick here, so here and here, right? Let's just say the average range. So what we're doing is the ADR percentage measuring from here to here. Okay, so from the low to the high like this, what it's doing is it's getting an average over the last 20 days. This is how we think about the quickness of the stock. This feeds into the identification, which feeds into the controlling risk, because oftentimes we think about risk relative to the 20-day ADR percentage. How quick is the stock? Now with Coinbase, it may be prudent to go in with a 5% initial stop loss, where on Microsoft or Amazon or something that's maybe got a 20-day ADR of like 1.52%, going in with a stop loss twice that at the initial 20-day ADR percentage, and it doesn't seem that prudent to me. But what this is saying is over the last 20 days, if I just put 20D here, the average daily percentage range of Coinbase is 7.4%. It was a little bit less here, but let's just say it's 7.4% when this setup here is forming. So okay, this is then good for us to know because we can think about the initial stop loss here, about 5.5%. Okay, it's about 2/3, just over 2/3 versus the 20-day ADR percentage. Okay, it's acceptable. And then here, your momentum leader type stocks, you'll see that they can often set on the 10-day EMA. So now we're going into more kind of subtleties because oftentimes your 10-day EMA, which is your black line, is going to be too quick for the vast majority of stocks. So for me, I like targeting, as we've been doing in this course, trigger bars, shake out demand tails, and gap down reverse bars. Oftentimes that 10-day EMA is going to be too quick for the vast majority. The sweet spot is going to be the blue line on the chart, which is the 21-day EMA. However, with your quicker stocks, where your ADRs are 4%, 5%, 6%, 7.4% in this instance here, those quick stocks, they can set on the 10-day EMA. And the best way to also determine that is go, has this stock successfully broke out or bounced and gone on a nice trend off the 10-day EMA? What we could do here is we can take a look. So if you look at this prior trend for Coinbase, before it goes and builds this cup and handle type pattern, look at all these 52-week highs on the relative strength line, showing us there's a lot of leadership there. What do you notice? There's numerous shakeout demand tails around the 10-day. There's one there, there's one there, there's one there, there's actually kind of two in there, there's another one just in there, there's another one here. Go back and look at the prior trend, there's a nice shakeout demand tail here, there's another one here. But certainly in this prior rally where the stock goes up 141%, I'm not saying you're going to top tick it, but it has the character to do that. So you can see numerous shakeout demand tails off the 10-day EMA. So then when you're thinking about a setup over here, okay, you're then thinking, well, how far may Coinbase go? How far may it go if this thing really wants to trend from a good size base as a decent causality? How far may it want to go? Well, before you get that kind of clear change of character, it's gone over 100%. So then you're thinking about your initial risk relative to the 20-day ADR percentage, but also relative to the character of the stock. Okay, if Coinbase wants to trend, could it go up 5 times, 10 times, if not more, as I chuck my pencil? Could it go up 5 times, 10 times my initial stop loss percentage? Well, based on the character, here, good rally, 100%, here, 141%. I'm not saying again a top ticket, but that's the nature of the stock. Okay, seems pretty asymmetric in nature to me, and it's setting in a region, so cup and handle and off the 10-day, where we know the stock can set and go from that level. Let me just clear the drawings, go on to another one. So this one here, MicroStrategy. So the best momentum stocks have the history and character to go up hundreds of percent. So this is ideal when you can pull back a chart and you can look at this and go, okay, MicroStrategy is now setting up. I think I'm going to show it to you on the next one. This was setting up on the same day as Coinbase, both of them crypto related stocks. When Coinbase is setting up there, same day you see MicroStrategy setting this cup and handle. We're going to talk about themes next week. So themes and groups all setting up around the same time. Let me do a little bit of a case study on MicroStrategy and Coinbase, and then also thinking about quickness and things like that. So if I just go forward a slide and then I'll go back to this slide on MicroStrategy, we need to see MicroStrategy setting up. Again, it's this cup and handle. You can see the volume coming through, the 52-week highs, textbook cup and handle type pattern. Your initial stop loss in this instance here could have been 3.72%. For Coinbase is there instead of MicroStrategy, hindsight 2020, it is what it is there, right? But if you're then thinking, how far may MicroStrategy go before it starts closing below 10 days, 21 days EMA? Well, it's not listening to what someone on CNBC is saying, oh, my price target for MicroStrategy is this or it's this. Who cares? Nobody cares, right? The best thing to do is this. Go back and look at the chart. Okay, if MicroStrategy wants to come out of a base, how far may it go? Let's go do a case study. Let's go look. Okay, when it builds this type of continuation type base, flag, wedge, pennant, Darvis block, cup and handle, VCP, ascending triangle, symmetrical triangle, channel, whatever you want to call it, right? How far does it get? So how far does it get? What is reasonable to expect? Now, within reason, the more kind of breakouts from continuation type bases that you can get, I think the more accurate you can kind of deduce how far the stock may go, whether it could be 50%, 100%, 200%, 5%, 15%. So you can see here it sets this nice little pivot around the 10 and 21. Here it kind of breaks out, here it kind of break out, but the entry is actually down here or in here. Here it builds this kind of flag type pattern here. There's a nice shake out the Montel here. Then you want to go, okay, how far did the stock go? Well, actually it gapped down pretty significantly below its 21-day EMA. It's not looking too good there. 50 are going to give a lot back. So what we're doing here is we're building a case study for, okay, how far may this stock go? We know it's got a good ADR. Imagine that the ADR around this time is 8.64%, right? So what we can do here is go, okay, how does this stock like to trend? And then when it comes out of these continuation type bases from trigger bars, shake out to Montel's, gap down, reverse bars, how far may it go? And then the question that we're also asking ourselves is, what do we think is going to be optimal? So I'm just going to spend a little bit of time on this because oftentimes for your momentum leader type stocks, they end in a very climactic nature. Okay, so the way I think about optimizing profits, so that is basically what are the selling rules, selling guidelines that you are using to optimize profits, both in terms of monetary gain, but efficiency of the monetary gain as well. So if we take a look here, right? Let's just take this one. I'm just going to do a single example, right? I'll just draw a straight line across, right? And let's just say the breakout point is here. It's not a particularly good entry. There's better entries in the base down here. But let's say that this is going to be your entry point. So I'm just going to put E here. So this is then useful because if you are then analyzing a setup, okay, for MicroStrategy in the present day, you can then look back and go, okay, if I was buying it here, what is going to be the best, say, moving average to use as a trailing stop? Do you think it's one? Do you think it's a combination of things? What are you then going to do if the stock displays a character and a history of getting climactic and extended as it did prior to this? Is it adjusting your stop loss to lower the day, lower the day, lower the day, and choking it off? Do you want to do it with all the position or part of the position? So here what you can see is using the 50-day as a trailing stop optimal relative to the 21-day to the 10-day, or choking it off when you think it gets extended from the 10-day EMA and going lower the day, lower the day, lower the day. 50, not as good as the 21. Then we look at, say, the 21 relative to, say, the 10-day EMA. Here it kind of closes, but it's a little bar you probably hold there. It's kind of a shake out demand, so you probably hold. There's a bit of discretion in that. But I would say the 10-day EMA is better than the 21. So the 21 is better than the 50, but I would say the 10 is better than the 21. But what happens when it starts getting up here and it gets very, very climactic? You get this very large volume coming through. Well, lower the bar, lower the bar, lower the bar with all or part of the position is probably going to be optimal. So 10-day EMA, choking it off, I think is going to be more prudent for this stock. So this is how you can start thinking about things in terms of, okay, let me get a feel for these stocks, and different momentum leader type stocks will act differently. These things are pretty darn volatile. Let me go through two more. Oh, we did MicroStrategy there. I'll just go through one more here as well. This is just to show the short interest as well. And I'm then going to talk about GameStop in a minute too. Okay, so Carvana. There's one where I was buying it in here. It was nice inside bar, gap down, reversal bar, 10, 21, and 50. So it's got a good size base. It's got this cup and handle type base to it here. You can see the 52-week highs, the volume coming in pre-base, really good causality. And at the time of the entry here, the short interest is 43%. If you ever see something setting up that is a momentum leader type stock, so it's ticking the criteria we've been talking about, big base setting up nicely, trigger bar, shakeout demand tail, gap down, reverse bar, good 20-day ADR percentage, really liquid stock. If it's then got a short interest of 43%, that is extremely rare. Like extremely rare. That does not happen every single day of the week. So anything over 40 is very high. So 20% high, 30% very high. Over 40% is a little bit crazy, especially if the stock is setting up. So not every stock then does that. There was then earnings in the middle, so I was out before that kind of moving there. But the point is understanding what it is you're seeing. So if you can get a high short interest on top of everything else, can really be the proverbial cherry on top. So let me just show you how to quickly scan for these type of setups that you were seeing with Carvana there, MicroStrategy, Coinbases of the world, and the Teslas. And let me just show you how you can quickly scan for those, and then we'll go into a little bit of I'll do GameStop, and then we'll do a bit of the bar by bar stuff, and I'll take you through some interesting ones. So this one here, it's a preset screen. Go in stock screen, here we go, preset screen, scroll down here, US powerful uptrend with high dollar volume plus high ADR percentage. If you want to then copy the screen and tweak a couple of things, by all means. And see Thomas happy to join it. Yeah, that's brilliant. Thank you for Thomas. So US powerful uptrend with high dollar volume plus 20-day ADR percentage. So what are we looking for? Well, the screen here, country, so US stocks we're looking for here, price above the 21-day EMA, price above the 50, price above the 200, average dollar volume on a 50-day basis greater than 100 million, and the 20-day ADR percentage greater than 2.25%. If you want to play around with that, stick it to 3%, 4%, 5%, then you're obviously going to be focusing more so on the quicker stocks. That takes our universe down from around about 5,500 US stocks to 171. Now there's two, you can look at this a couple of ways. You can look at it relative strength. My favorite way is actually looking at the most liquid stocks first. So the highest average dollar volume on a 50-day basis, or looking for the quicker stocks. So if you go for the highest average dollar volume first, you're going to be familiar with a lot of these names: Nvidia, Amazon, Google, Broadcom, Micron, Netflix, Taiwan Semiconductor, so on and so forth. Right? If you go highest 20-day ADR percentage, so what are we doing for now? What are we doing now? We're looking for the quickest stocks first. So the quickest one. So what we see is we've got CGC, Trump Media and Technology Group. That might be a little bit polarizing. Remember what we were saying? Polarizing, high short interest. Obviously not American, I'm not political, but you'd imagine there, if that one starts selling, there could be a high short interest. It's going to be a very polarizing company. I don't know. Soundhound. So if we start taking a look at these, Reddit's in there as well. So if you start looking at these here, see, you've got CGC, right? So these are what these kind of momentum leader, really volatile, high 20-day ADR percentage, preferably liquid stocks as well. We know the stock's going to have 50-day average dollar volume of greater than 100 million. But if we just do this as well, what do we see? Well, we can look back here and go, oh, okay, the character of a stock in Q3, Q4 last year. Look at this. Look at a huge move from $4 to around about 20, just under $20, high teens. So this explosive nature. Now, obviously, cannabis-related stocks can be very news-driven, whether it's going to be legislation coming in or things like that, right? So you've got to be aware sometimes of the fundamentals going on. But seeing this is good to go, wow, the stock can move really quickly. But then you want to be aware of how do you optimize the profits? If a stock's going to do that, how do you optimize the profits based on the character of the stock for what it had done previous time? So if we then go through here, okay, Soundhound AI, you can see going from $1, $2 up to $10, so it goes up about 500% or so, a little bit more, and then potentially creating this lower pivot around a clustering of 10, 21, and 50s. GCT, you can see this here, basing IC, 10, 21, 50 are all there. Carvana that we were talking about a little bit earlier, the setup was in there, so that's why we were then looking at it here, and then you can see, okay, still up here, good short interest on it at this moment in time. You've got Reddit, so a newer IPO related stock. So this screen here will bring some of those or bring some of those type of stocks up. So that is how I would try and screen for those type of stocks efficiently, very efficiently. So let me just talk about GME, right? So you can see that GME is just powering higher, right? It's gone up because it's quite funny why the stock seems to have gone higher because of someone posting something on social media. But hey ho, it's funny, right? So this stock here is up 500%. It's okay. GME, if you go and take a look at it, so GameStop, right? We can then go back and assess the character of the stock and go, well, this stock here, when it wants to run, can really run. If I remember correctly, the short interest on this stock here on the 22nd, heading into Friday, the 22nd of Jan, I think the short interest was about 140%. So 140% of the stock's float was sold short, which is absolutely lunacy. Can you imagine that? 140, we don't have to imagine it, it's right there. 140% of the stock's float is sold short, and look at the chart. Does that look like a stock that wants to go lower or wants to go higher? What do you see? What do your eyes see? Like, so this is where you can get these kind of extreme momentum type stocks, and the high short interest is just that extra cherry on top. But then when you look at GameStop and you go, okay, how does this stock like to move? And actually, if you go and look at these earnings gaps, or sorry, not earnings gaps, but if you go and look at the gap ups for the stock, because here you can see, okay, it's gapping up, but kind of faded. Okay, yesterday kind of gapped and a little bit volatile. It doesn't really like to kind of gap and go, so to speak. If you look at when it gaps, it usually fades. When it gaps, it kind of fades. When it okay, gap here, but then fades, gap here, and then it just sold off. So you can start getting a feel for the character of the stock right here. You can go, okay, kind of gapped and faded there. Okay, kind of pushed there a little bit and kind of ran. And when you go and look over here as well, you go, okay, kind of gapped and faded, okay, but here gapped and faded here. So actually, when you then start looking at it and go, okay, how does GameStop like to set up? So I've got GameStop now high on my radar, and I'm like, well, actually, I'm looking for it to pull into the 1021 and set, pull into the 1021 and set, pull into the 1021 and set, like down here, basically the usual kind of setups. So this is where you can start getting a feel for the stock as well and go, okay, does it like shake out tomatoes? Does it like trigger bars? Does it like gap down reverse bars? Where does it like it as well? So it's a useful exercise to study these stocks, because how GameStop moves is going to be very different to how Google moves, or how Amazon moves, or how stock ABC or XYZ moves. So stocks, they're all unique and they all move a little bit differently. So I can see that Thomas is happy to join in. So let me bring Thomas in for a bit of bar by bar. Hey guys, hope you and the families are well. This is the live coaching session. Today's date is the 20th of May 2024. So this session here is going to be about group theme leaders. So this is a continuation of what we've been doing in recent weeks with looking at true market leaders, momentum leaders, and then group theme leaders. So this is going to be the kind of final part of the trio in terms of how I think about different types of stocks. So let me scroll down here to 130 and just give you an overview. So this is a group theme leader. So what are we looking for? We're looking for a strong group or theme ETF chart, and the group or theme showing relative strength. Many applicable stocks within that group or theme showing relative strength, and many applicable stocks building bases. So that's your continuation bases, flags, wedges, pennants, Darvas boxes, cup and handles, ascending triangles, VCP, symmetrical triangles, all of that good stuff, right? So many applicable stocks are building bases and acting well. What you will tend to notice with these group theme leaders is the market is quite thematic in nature. So what you tend to see, or what I tend to see anyway, is that stocks from the same group or the same theme, that could be solar, it could be EVs, it could be semiconductors, it could be oil and gas stocks, whatever it may be, you'll tend to notice they kind of set up around the same time. So then it's about deducing, okay, which one am I going to target based on the information that I currently have available to me. So that's what I'm going to be trying to take you through. So this one is going to come at you pretty darn fast. So we'll do this. I've got a couple of slides. How many slides have I got? Around about 6 slides or so to illustrate the main points. Then we'll go on to TradingView. If any of you want to join in during that part, let me know in the chat. Otherwise, I can rock and roll by myself to really illustrate the kind of nuances of specifically what I'm looking for. So this is going to be some pretty in the weeds type stuff. So one of the things that we want to be looking for when you are looking for strong themes is relative strength. So how do we mere mortals try and identify relative strength? The simplest way I know is look at relative strength lines and or relative strength rankings. I like a combination of them, but what I like to see is if the group theme, which is TAN, so this is solar, okay? So this is the main solar ETF. What do you notice during this time? Well, TAN here, so the ETF. So think of an ETF as a bucket, and the bucket is made up of a lot of component stocks related to the ETF. So in this instance here, the TAN is the bucket, and the bucket is filled up with solar related stocks, right? What do you notice? Look at all these blue dots. What do these mean? It means it's 52-week highs on the relative strength line versus the S&P 500. This is what we like to look for. This is leadership. It's really, really, really important. We're going to go down in a couple of maybe a couple of slides time, actually, maybe the next slide, where we then go and look at TAN at this moment in time. It's building a nice kind of flag continuation type base here. I appreciate it's a little bit small, but I want to keep more information on over here, okay? But what do you notice TAN? Well, it actually goes and builds this really nice flag type pattern. There's 52-week highs all over the place. And from point A being the high here, which I've marked with the blue arrow, okay, from point A to then point B being the high of the pink arrow, what do you notice TAN did? Well, TAN built a base, got a shakeout to Martel, gap down reverse bar, and then it tightens in there on the 1021, and then runs up around about 34%. What does the S&P 500 do during that time? It's actually down -4%. So this is the point about focusing on relative strength. The S&P 500 during the same time period as TAN is running here. So remember, TAN is the ETF. That is the bucket with a lot of solar stocks within it. TAN has run up 34%, while the S&P 500 is down 4%. Where do you want to be focused? Where do you want your exposure? This is the point about dialing in and really focusing on relative strength. Then the question becomes, okay, if the theme chart, the ETF, whatever it may be, in this instance here it's solar, is displaying a lot of relative strength, it's basing constructively, and you can see a lot of continuation type bases in terms of individual stocks, which one do you then go for? Okay, because as TAN is basing here and building a flag, there's going to be a lot of solar stocks that look quite interesting. But how do you then reach the conclusion for which one you are going to target with the information you currently have? It's really easy in hindsight looking in the rearview mirror, but what do you do in real time? What do you do when the stocks are setting up and you're planning and preparing as best you can for the next session? So we'll dive into TAN in a couple of slides time, maybe even on the next slide. Here we go. Let's go to the next slide here. Here you go. This is TAN. So remember, I was just blabbering on about TAN was building that nice base. Okay, so TAN is building this kind of flag type base in here, right? It's pretty constructive base. Appreciate it's a little bit small to see. You have a gap down reversal bar, you have a shake out to Martel, tightens up here, shake out to Martel on the 10 and 21. It's a nice base. We saw the relative strength line. Take a look at the S&P 500. The S&P 500, you see the blue dashed line across all of these? This is what it was doing on that day, which I think is the 24th of September. My memory serves me correctly. So as TAN is here and TAN is basing, TAN literally starts breaking out. Remember, that's the solar ETF. That is the bucket in which the solar stocks are filling it up, the component stocks. So TAN is just the bucket, and then it's filled up with component-related stocks. So as TAN starts breaking out, on the day it breaks out is the day after the major indexes put in their lows. Isn't that quite interesting? So the day TAN starts breaking out is the day the S&P 500 bounces off its lows and puts in its low. So this is the point about the indexes can look absolutely terrible, but I'm not dictated what the indexes do. I don't really care to the extent when I'm actually looking for group and theme relative strength, because I've just seen it 1,000,001 times. If you're just waiting for the indexes to look rosy and everything looks absolutely tickety-boo and the sun's out and your sunglasses are on, like, you're going to miss probably a lot of the best trading opportunities in terms of the really strong areas of the market that couldn't be dragged down with the indexes going low. So if you look at TAN, you just look at TAN, I'll spend a little bit of time on this one, right? Look at the S&P 500. What does it do? Lower low, lower high, lower low. What does TAN do? Well, it makes a lower low, then puts in this higher low and starts tightening, and then breaking out of this flag type base literally is the indexes putting their lows and then reverse off the lows. So if you're just staring at the indexes and you're like, well, the indexes, they're below their 50-day, they're below their 10, they're below the 21, guess what? You just missed a load of opportunities. Like, there's no, some people say like nothing good is like nothing good happens below the 21-day EMA. Well, I don't think you're doing your work properly. Like, a lot of good things do happen when the major index is below their 21-day EMA, but you've got to be in the right areas. You really, really got to focus and dial in and go, okay, where do you want to be? So then the question becomes at this moment in time here. So as TAN is building this base over here, remember, TAN is the bucket. Okay, the ETF is just the bucket, and then there's a lot of component stocks that make up that bucket. So then the question becomes, which is then the best setup to be targeting? And this is the thing, the market will give you these kind of pockets, these spots where you can be pushing it and pushing it hard in specific areas. So we're looking at solar stocks here, and what you'll see is these are all on the same day. Okay, it's the 24th of September, if my memory serves me correctly. So you've got M phase energy. So let's call this 1, 2, 3, and then 4 here, okay? So these are 4 solar stocks, which make up the bucket, being TAM, being the ETF, right? So when you look at these stocks here, you can kind of see, well, that kind of makes sense why TAM was basing as it did over here. Can I just erase this bit here? There we go, like that. So as TAM was basing over here, it kind of makes sense, right? Well, if we look here, SPWR, okay, it's got a shakeout demand tail. Canadian Solar, this one looks pretty constructive, building higher lows, gap down reverse bar, shakeout demand tail. M phase energy, the big boy of the group, okay, 10, 21, and 50, clustered, building just higher lows here. A few gap down reverse bars, some shakeout demand tails, kind of this low pivot building in there. So then the next logical question is, okay, if you've just identified a strong theme, a strong group, and you see the ETF, and you're like, wow, that's a lot of relative strength, spacing, flag, wedge, pennant, Davis box, VCP, sending triangle, symmetrical, whatever it may be, right? And then you look underneath the hood. So now what you're doing is you're looking at the component stocks within it. Okay, so what I'm going to do here is draw a really bad picture because sometimes visual things may happen. Okay, this is TAN. This is a bucket. Ella was at the beach earlier, so this is kind of a bucket, right? So this is the bucket. Now, what makes this up is all of these things in here, which are stocks. Okay, component stocks. Now, some groups will have a lot of stocks like semiconductors and software. Some stocks, some group themes won't have that many. If it's copper, there's not that many copper stocks. If it's GDX and it's precious metal miners, okay, maybe there's going to be around about 20 or so. Semiconductors, there could be many, many more than that. But then the question is, which one are you going to target? So they're all kind of setting up on the same day, right? So which one are you going to target? Are you going to target Enphase Energy? Are you going to target Canadian Solar? Are you going to target First Solar? Are you going to target SPWR? Are you not going to target any because you're like, well, S&P 500 is below its 50-day, it's below its 10, it's below its 21. So this is where you identify relative strength in terms of the theme and the group, okay, theme and or group, and then you start looking underneath the hood and you go, okay, where is the leadership? And what you'll tend to find is when you look underneath the hood, so you're looking at the component stocks which make up the ETF, in this instance here being TAN, what you tend to find is there are true market leaders and momentum leaders. Make sense? So what we've just been doing in the last couple of weeks in terms of looking at the criteria for TML type stocks and then looking at the criteria for momentum leader type stocks, you then apply that we've just done in the last couple of weeks to then looking for the TML type stocks and the momentum leader type stocks within the really strong group, within the really strong theme. That makes sense? So the TMLs and the momentum leader type stocks, when you're then looking for, okay, where is the strength in terms of the theme, in terms of the group? Is it solar? Is it EVs? Is it oil and gas stocks? Is it semiconductor stocks? Is it software stocks? Is it AI stocks? Is it mean whatever it may be? Then you're looking underneath the hood and going, okay, which one do I want to be? Which one do I want to be targeting? So in this instance here, SPWR is going to be a pretty good one. CSIQ is going to be a pretty good one. And then potentially Enphase Energy, if you like, this is the real TML type stock and it's right there on its 50-day. And I think the bigger boys and girls are going to be there. But the one that is horrendous is First Solar. The relative weakness that it's displaying relative to SPWR, CSIQ, Enphase Energy. Like this one, okay. But if you want to be in probably the two leading ones, it's more so going to be CSIQ and SPWR. Look at the strength. They haven't even touched their 50. Didn't even touch their 50. That's the strength. Okay, so all of this is happening while the index is doing this. This is relative strength. Relative strength will lead you, I think, to the best opportunities in the market. Let's go to the next slide. So this one here, right? This is more kind of dialed in. This is recent. These charts are taken as of today's date, right? So if any of you have been trading in the last couple of weeks, you'll probably see, wow, precious metal miners have been quite strong, and I've been trying to focus on them as well. So why have I been trying to focus on precious metal miners? It's the same point, right? If we just start from point number 1, so we'll just call these point number 1, point number 2 as well here, and then point number 2. Excuse the bad handwriting, okay? But here you go, right? When the market pulls back, that's where we really get to see the relative strength. So that's where we can really, really focus. And again, it's about trying to identify themes, groups that are displaying strength. So themes and or groups, right? Sometimes you can have kind of, the theme can be different to the group. Like it could be, okay, the theme is actually AI. So you may have a lot of semiconductor stocks showing strength, but it's actually the AI component to it, which is where you're seeing the real kind of juice and the real kind of nice setup. So you got to understand kind of the theme and the group, and there's no shortcut to doing that. I'll show you one way that you can kind of scan through things once we finish these slides. But if we go to number 1, okay, which is the blue arrow, what do you notice? Well, silver miners has just pulled back in to its 21-day EMA. And what bar does it put in? Gap down reversal bar. Has it closed below its 50-day moving average? No. Did it even get close? No. So while the S&P 500 was rolling out of bed here, and it's below its 10, it's below its 21, and it's below its 10, and then does pop up above its 10, Silver Miners SIL pulls back as well, but it pulls back in a much more bullish manner in terms of the individual candlesticks, but also in relation to the moving averages. Just pulls back to its 21-day EMA. After it's just been on a run like this, you've got to have a little bit of common sense think this thing is probably going to pull back. So it pulls back at point number 1 to this blue arrow, but it pulls back in a very bullish manner and a lot of relative strength versus the major indexes. Okay, check. What then happens at point number 2? Well, it bounces and then it puts in this higher low, gap down reversal bar, low relative volume. So it's again at its 21-day EMA putting in a higher low. Higher lows are structurally bullish. Interesting. What does the SPYs do during that time? Well, it kind of bounces and puts in this shakeout demand tail, but note how it's living below. It's 50, it's 21, so 50 is the purple line, the blue line is the 21, and it's right there kind of on the black line, the 10-day EMA. So again, it's still below its 50-day, being this line here. But look at silver miners, just way above it. Look at the distance. This is relative strength. Do you think there are probably quite a few precious metal miners that look quite interesting? You got it, there are. And then if you look at number 3, well, silver miner SIL is now building this pretty constructive base in here, and then the S&P 500 is able to kind of rally, put in this cup and handle type pattern, and then starts moving to the upside. But silver miners during this base building time has displayed a lot of relative strength. So this is the point about, okay, when you see the indexes pulling back, like for me, that's the time to really, really focus and go, okay, this pullback is going to lead to a lot of opportunities. That's a useful framework or useful mindset to be operating from. Okay, when the indexes pull back, I really, really like it because that is where you're going to get to see the relative strength. If you know what you're looking for, it sticks out like a sore thumb. You will see it. You'll go, wow, the indexes look pretty terrible down here, but take a look at silver miners. Like, it's not the time to be going, oh, the world's going to end and this is going to happen and the world's going to fall out. No, it's the time to focus. It's really the time to focus. Let's go on to the next. Copper miners, exactly the same exercise. So we're going to take a look at FCX and SCCO in a couple of minutes' time when we're on TradingView. But it's the same exercise, right? If you look at the blue arrow, copper miners, COPX, okay, it's been on a rally. Things not going to go up in a straight line forever. It's going to pull back. It's going to build a big base. If it's going to continue trending up, there's going to be a continuation type base. So what do you notice? Well, at the blue arrow, copper miners just pulls back to its 21-day mate. Note the distance from the 50. Well, what has the S&P 500 done? Well, it's the same thing as silver miners in the chart beforehand. It's pulled back down below the 10, below the 21, below the 50. See the difference in relative strength at that point. Now, relative strength is relative. Okay, the puck keeps moving. You've got to do this every day, every week. The puck moves. Okay, the game moves. It's not stagnant. It moves. The market is always in a state of flow. So you've got to flow with it. You've got to be adaptable. There can be one day where copper miners are showing a lot of relative strength. And then what if copper miners on the next bar did this? And it's just a red bearish engulfing candlestick and the volume is way up here and it looks horrendous. Are now showing a lot of relative weakness. It just is what it is. The game moves. The game evolves. You've got to evolve with it. Then you see here, at this one, pink arrow. See how it holds the 21-day EMA, puts in this high low. Look how the volume's drying up. Look at the difference in relative strength. When you look at it structurally versus the moving averages, you can also see the relative strength line turning up. So not always are you going to get nice blue dots and the market makes it nice and easy, right? But these are the type of subtleties that you're then looking for. And then it's about going underneath the hood and going, okay, copper miners. So at bar number 3, or point number 3 here with the orange arrow, okay, copper miners are showing a lot of relative strength during this base. Then it's about going underneath the hood, looking at the component stocks that make up CPOX, for instance, and going, okay, what are the TMLs? What are the momentum leaders within this specific ETF? Now, there's not that many of them, so it's easier to be able to find them because maybe you're scanning through 5 or 6 rather than semiconductors and you're looking at 50 or 100 or something like that. So the less stocks there are to an extent, the easier it is to then identify the leadership. So hopefully that there is making sense. I think I got a couple more. So this is then about, you can see areas that were displaying a lot of relative strength. So HACK is the ETF here. It's a cybersecurity ETF. Prior to this, which you can't see, so over here somewhere, prior to this, HACK was showing a lot of relative strength. You had CrowdStrike, you had CYBR, I think, you had Palo Alto, you had some other ones showing a lot of relative strength. So stocks will show relative strength until they don't show relative strength, and then they will show relative weakness. Now you can look on that in terms of a really micro perspective, so on a day-to-day basis, where you could look at it in a little bit more, micro perspective, or a more macro perspective, where you zoom out and you see the longer term trend. I think it's important to be aware of both. You want to be aware of as much as you possibly can in terms of it helping you make high quality decisions. So I want to be aware of the macro and also the micro. I want to see the bigger picture, but I want to zoom in and see the individual pixels. Okay, really just in the weeds, trying to be very, very concise, very precise. So if we take a look here, Hack is displaying relative weakness. So if you look at it, it's just rolled out of bed. There's no relative strength, right? You see this bar here where it's just rolling out of bed. It's lost the 10, lost the 21, and lost the 10-day EMA. Looks horrendous. What did the market do on that day? Well, the market, bad session, loses the 10, loses the 21, but does it lose the 50? No, it didn't get close. So Hack here is displaying relative weakness. Then you fast forward over here. Look at the relative weakness Hack is displaying relative to the S&P 500. Both look pretty terrible. Hack is even worse. Okay, this is displaying. So do I want exposure in cybersecurity related stocks? No, is going to be the answer. Why? Because the market is currently saying we don't like cybersecurity stocks as much as we like other areas of the market. So it's about having the humility to go, okay, cybersecurity was showing a lot of relative strength. Now it's not showing relative strength. Now it's precious metal miners. Now it's copper stocks. Now it's whatever stocks it may be from that specific group and that specific theme. So what you'll tend to notice is people just get fixated on this stock or this group is going to go on a mega trend and it's going to be fantastic forever. And the market just doesn't move like that. It wiggles and jiggles and you got to wiggle and jiggle with it. So when we start looking over here, if we just fast forward to this bar here, okay, the orange area one, which is then this one here, why would you be targeting a cybersecurity stock at this point here? Look at the group. Look at the S&P 500. S&P 500, okay, kind of bounces, cup and handle type look to it. Act just terrible. Relative weakness. Not above the 10, not above the 21, not above the 50. So what are you doing looking at any cybersecurity stocks? There's no point. Right? There is no point. You want to be dialed in on, okay, where is the relative strength in the market? And maybe at any one time, you could count the really strong areas on the market on one hand, potentially you can go on to two hands. Okay, but it's usually pretty focused, pretty concentrated. But this is how I think you can reach a conclusion and deduce from what the market is saying, not what someone on social media or someone on mainstream, CNBC, Bloomberg, whatever it may be, is telling you. Like, you can just visually look at it and go, what does the market think? Like, you don't need to worry, myself included. Don't listen to anything I say. Just listen to the market. What do you see? What do you deduce? Where do you see the leadership is? Where do you see the leading stock within the leading themes, within the leading groups are? There's really no need to talk about it. Like, the market just gives you all the answers if we are willing to listen to it. So then this is just to illustrate the point about relative strength and relative weakness. This is take a move. Now, prior to this, what was it, 2021, 2022, was showing a lot of relative strength. And it was kind of then phase redistribution top into a phase 4 downtrend, but there was a lot of relative strength in this area and the stocks that make up this ETF being moved, which I think is a really good name. So it's agricultural related businesses, right? But what do you notice? So we were talking about TAN earlier and those blue dots, 52-week highs, free tool. I'm sure you guys know. Search my name on TradingView, you'll find it. Jack Corsellis, RS line. Okay, these red dots, sorry, are 52-week lows. So 52-week lows versus the S&P 500. These are bad. Okay, let me just write 52-week. That's supposed to be WNLS. 52-week lows. These are bad. Okay, so if you were just like, well, I love agricultural business and there's supply chain shocks and there's grain shortages and this is going to happen and I'm going to put that price, like maybe there's some really good fundamental reasons, but the market doesn't care. This is the point about relative strength. It's not my opinion. It's not your opinion. It's the opinion of the market. So if you were long, move because you thought for some fundamental value reason or whatever that, well, these stocks are going to do really well because of A, B, C, D, and X, Y, Z. Well, you just got your ass handed to you. Okay, it's gone from like $80 down to $60, and it's just been absolutely terrible. Okay, you just had a big drawdown, and then you just had dead money for months and months and months, 9 months. Like, what was the point? What was the point? You could have just been long the S&P 500. Do you see the difference? So this is where relative strength, both in terms of individual stocks, but also looking at the groups, looking at the themes and thinking, where does the market want to be? And oftentimes you'll see groups, you'll see themes that are setting up, and maybe you can find some nice narrative, some nice kind of article to explain the strength that you are seeing. Oftentimes, the reason you think a group is strong is not actually the reason. So I think it's quite a dangerous rabbit hole to go down. I wouldn't try and know all the reasons why. You just want to know what is. It doesn't matter why copper stocks are displaying a lot of relative strength or precious metal miners. And if you start Googling narratives, I think it will really mess you up. Because if you start Googling, okay, why are precious metal miners showing so much relative strength, you'll get things about, well, the dollar is going to crash and Bitcoin is going to be the reserve currency of the world and the dollar is going to lose the reserve currency. It's going to be hyperinflation in the US and the world's going to fall out. And then, like, is that a good emotional state to be trading from? No. And the way people get you to click on the articles is it has to be dramatic. Like, you see it in sport and things like that all the time. It has to be some dramatic headline for a pundit said this, and it was this dramatic quote and these things. Like, it's just clickbait stuff. So if you start looking for the articles, for me anyway, maybe it's ADHD and things like that, and how I'm kind of wired up, is it just completely messes me up. I don't really want to know the reason. I just want to know it's really strong. And I can see that by looking at a chart. I don't need anyone else's opinion. I can just see it. Okay. So once you learn, okay, these are the types of setups. These are the setups, which is kind of the logical flow to this course. These are the setups. You can go back, you can look 100 years ago. Nothing has changed. These are the setups that just keep on happening. Trigger bars, check out demand tails, gap down, reverse bars. Leadership keeps happening. Leadership keeps happening. Now, it will be leadership in terms of individual stocks, but also in groups and themes as well. So it's know thy setups, know what groups are strong, which is going to change on potentially a daily basis, a weekly basis, and then what stocks are strong, which is going to change on a daily basis and a weekly basis. I've got one more slide, and then we'll go and do a little bit of a little bit more detailed stuff. So this one here, okay. So this is taken at present. This is taken at present day, okay. So this is then trying to think about, okay, you identify an area of the market that is strong. So GDX at this time, I don't have the chart of the SPYs, but GDX is one of the main gold miner ETFs. Okay, so think of this as the bucket. Okay, so GDX is the bucket. Let me just draw it here. Okay, GDX is the bucket. Then what makes up the bucket is you got HMY, you got EGO, you got AU, you got NEM, you got SAND, and obviously there can be some skewing because of market capitalization of certain stocks as well. Okay, so GDX is our bucket. Then it's a point of, okay, GDX, precious metal miners, are showing a lot of relative strength. So then you start looking at the charts. Okay, I would look at the charts first before the fundamentals. So I'm going to bring fundamentals into this a little bit, but look at the charts. Okay, the strongest stocks will display the strongest relative strength. Okay, the strongest stocks will display the strongest relative strength. So relative strength is not my opinion or your opinion. It's the opinion of the market, and the strongest stocks display the highest relative strength. That is just my belief system because I've looked at millions and millions and millions of charts. I've looked at millions of them, and the strongest stocks invariably will display the strongest relative strength. It may wiggle and jiggle, but the market's strongest stocks or the market's favorite stocks will display the greatest amount of relative strength. Okay, there is a reason why I started from this date here. So if you look at this, this is May of 2023 that we're circling for GDX, and then all of the gold miners. So which one is the market's favorite stock? If you were to rank these and go, okay, which stock does the market currently think is the real leader in terms of gold stocks that you can see here out of these five? Well, if we do a process of elimination, let's first and foremost eliminate anything that is not stronger than the ETF. So if you look at the high here in May, see this high in May? GDX is above the high in May, yes? You see that? GDX is currently above it, which I'm pointing to with the black arrow, right? If we do process of elimination, why is AU down here? See that? AU is making a big lower high. Now, has it displayed some relative strength? Yeah, it's broken out from this phase one base. Remember, we started this kind of course with the price cycle. So you get phase one, phase four there, phase one there. Okay, it's in the context of a phase two uptrend. Okay, nice, yeah. But if you don't have the context, so much of trading is context. It's context, 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 right? So if you don't have the context, you'll miss the subtleties. You'll really miss the nuances. If you were just looking at AU in isolation, you'd miss the point that I'm about to try and explain to you. Then if we go onto NE, and there's my stutter, okay? Okay, it's here. What do you notice? It's another lower high. Why is it not being able to get back above the May 2023 high? Has it shown a bit of relative strength? Yeah, the stock's been able to rally pretty well. But is it the real leader of the group? What we're trying to do here is we're trying to reach the conclusion for what is the real leader of the group. It's not AU, because it's not even structurally stronger than GDX. The ETF. The ETF, if you like, is just an average of the component stocks that make up to it. It's not even above the average in terms of technical relative strength. This one here, Newmont Corporation. It's not even above the average. It's not even up here. We look at Sandstorm. Okay, it's a bit better than NEM. It's had a good rally here, But again, lower, high. So this is not the leader. This is not the leader. This is not the leader. So then that takes us on to HMY and EGO. So if you look at EGO, Eldorado Gold, what's it made? Well, it's made a higher high relative to the May 2023 high. Same with HEM, HMY. High, high. Good trend, right? So now what we could start doing is we could start looking at things and start getting a little bit more tactile. Okay, both of them are displaying leadership relative to their peers, being AU, NEM, Sandstorm. Both of them are showing relative strength in terms of structural relative strength. We'll come on to fundamentals in a few minutes' time versus the group. They're both a lot stronger. Okay, they're much stronger. Look at the big high here for HMY. Look at the big high here for EGO. If we were to look at some specific moments in time, if we were to look at, say, August of 2023, about the same. They're kind of, yeah, about the same. If we were to look at the next low, okay, again, HMY, a little bit of a higher low, maybe it's a little bit stronger, but this is where we start to get the divergence of relative strength. Ready? If you take a look at EGO, this looks around about March 2024, okay? So this point in time here, see the pullback. Ready? See the pullback. What was HMY able to do? HMY was able to hold roughly the May 2023 high, whereas EGO, nope, slices through it. So relative strength, why is that? Because someone somewhere for some reason was willing to support HMY much more than they were EGO. So it's a sign of strength. It's a sign that there is someone, some entity, some large operators out there for some reason. We don't know their reason. And it's probably not going to be the reason that you can find Googling it and looking at clickbait articles. That's probably not going to be the reason. But someone somewhere was willing to support HMY here much more than they were EGO. So now when we look at it, okay, I'd be looking at HMY as the real leader of the group. We can then also bring in things like 20-day ADR percentages and look for, okay, are we looking at the TMO type stock? Are we looking at the momentum leaders type stock? We can do everything that we were doing from 2 weeks ago. If I go back here, so if I just go and pull these up here like this, okay, we can then start looking at it and go, okay, we potentially identified from a technical standpoint, what do we think is the strongest stock for everything that we just said with HMY? Then we can start diving into it and going and looking at some of the things that I think are most important that we covered in terms of TMOs. Are we seeing mega earnings coming through, mega sales coming through? What are the EPS estimates coming through? Are they into all-time high territory? Has forward guidance been raised in 52-week high territory, all-time high territory? What is the ROE relative to its peers? All these other things, right? So then you're trying to decipher, okay, is this the TML type stock of the group? Is it the momentum leader? Is it potentially both? Is it the TML where it's got the big earnings, the big sales, the big estimates, forward guidance has been raised? If it's a different stock other than like a precious metal miner, maybe they've just been awarded a new contract, they've got a new product, whatever it may be. And then you may go, oh, and it's also the momentum leader of the group. It's got the highest 20-day ADR percentage of the group. It's the most liquid in terms of 50-day average dollar volume. So then suddenly you're like, check. Taken a lot of boxes. See a question from Abdullah, a question from maybe later. Assume you're in advanced listed, the top thematic. Do you also compare ETFs from the same theme? Not really. Yeah, you can, but I would try and stay with the most liquid. So you're asking about SMH versus SOX. I don't really see the point of doing that. So if I take you through a quick illustration for how I'd now look to do this, right? So let's go load this up. Let's go NU over here. Let's go, okay, NU here. So this is importable. Let me go get it. Okay, this is importable from the platform at this moment in time. And what this basically is, so it's from, if you go here, if you go here, if you go here, like this, and once it loads up, okay, so this one here, the importable links, right? This one here, TradingView tickers in Trend Monitor. You can get it for TC2000s. Like if you scroll down, all of these tickers, they're going to be in the TradingView one. I'm gonna show you. So for me, I do this once a week. Okay, look and go. Okay, where do I think it is? Do I think it's phase 1, phase 2, phase 3, phase 4? Could be early or late within those phases. And the blue areas are the areas where I'm most interested in. So what I'd say with the ETFs is this is the collection of ETFs that I've put together. You also have some of the equal weights coming through here to help avoid some of the skewing that you can see in, say, like XLK, where obviously the mega cap technology stocks kind of like skew it. So you've got to be aware of that. But when you're building out this list, ideally you want to see some liquidity there. So I'd say try and focus on the more liquid ETFs. But if we go and load this up, right, what I'd be doing is just scrolling through, right? And I'd be looking at these, trying to identify relative strength. If you find it useful, you could overlay them as well. So you can set up a TradingView chart where you could go and say overlay it like this. Let's do that. And then what you could do is you go, if you could do it for the relative strength line. You could just look at the relative strength line, but if your eyes work better like this, what you can do is say, do this. And now you can just go through groups and themes, and you can start looking and go, okay, block, okay, it's been down here. It's not really showing any relative strength versus the market, but it's kind of tightening. Okay, AI powered ETF, okay, kind of tightening there, but you see how the market pulled back down. The market, there we go. See how this one here pulled down nearly to the 200, where there was a lot of distance here to the two. Okay, it's not displayed really a lot of relative strength. Let me go and find maybe one that's going to look a little bit more interesting. Okay, XME, for instance, right? So these are the things you then want to be identifying, which we're going to do in a second as well, is if we put it there, 8th of May, and then here on the 8th of May, well, what do you notice? Well, while the S&P 500 made a lower low and then lower high, but below its 50-day moving average, see that? Below its 50-day, what do you notice XME did during that same time? Well, XME comes down, holds the 50, bounces, puts in a higher low. So what is the market telling you is currently a strong area of the market to be looking for and looking to be scanning in? And again, this changes on a day-to-day basis. So it's important, I think, to at least do it on a weekly basis and kind of update your decision-making process. Where do you think the strength is? Where do you see the relative weaknesses? But this is going to then get my attention to go, okay, market looks absolutely horrendous, but XME, okay, this kind of looking pretty darn constructive. So that's a useful exercise that I'd be going through. Let me then take you through some of the more tactile type things. So I'll start with this one here. Okay. So both of these stocks are from the same group. So as I said a little bit earlier on, what you'll tend to find is, so both of these are data center storage related stocks in general, right? So you've got PSTG on the top and you've got NTAP on the on the bottom. Okay, what do you notice? They both look pretty similar, right? And this is the thing, that the market will tend to give you the kind of, the way I kind of think about it, the market will give you a point in which to try and get on board, which is the optimal point. So for me, that is going to be in terms of continuation type basis, but then you see the shakeout demand tap, you see the gap down reverse bar, you see the trigger bar, and they are kind of like triggers for me to be going, okay, now is the time for me to act. Now is the time for me to be doing something. And what you tend to see is these stocks here, in terms of data center, data storage related stocks, they're pretty much showing up at the same time, right? You have NTAP on the bottom, is earnings gap over here. You have pure storage, earnings gap. What you would say is, well, NTAP put in this big supply shoot that hit 52-week high, which is good. But what did pure storage do? Well, it gapped up, opened on the low of the bar, pushed up, 52-week highs, good volume coming through, pushes up in subsequent sessions. Whereas NTAP, okay, supply shoot and pulls back down in subsequent sessions. Now, some of that may be in terms of the market environment. What did the S&P 500, the triple Qs do around that time? So you've got to be aware of that. You've got to be aware of a lot, right? But on the face of it, what would you say is the stronger earnings reaction and post-earnings reaction in the immediate week afterwards? Pure storage, right? So if we were to just highlight these areas over here, so I would literally take you through my thought process. I do it a little bit quicker than this in the evenings, but this is what I'm thinking. So in the blue area, the earnings reaction, pure storage wins, right? Pure storage wins. And then if we go and look over here, I'll kind of get to the final point actually, rather than kind of labor on the point too much. They look kind of similar as their base, and there's some constructed bars around the low. So I'm always looking around the low, shake out demand tail, gap down reverse bar, shake out off the 50, shake out off the 50, gap down reverse bar off the 50. Okay, you've seen some large operators step up where you'd like them to step up. NTAP, okay, comes down to the 50, little undercut there, not much volume, pretty tight bar. Okay, starts to recover, and then it goes and puts in this higher low. So both of them are setting up around a tight clustering, multi-week. I wouldn't say it's multi-month based, but multi-week based one. They're both setting up around a clustering of 10-day, 21-day, and 50-day moving average. On my chart, that's the black, the blue, and the purple line, right? They're both, in general, they look quite similar. So now what we try and do is we try and decipher, okay, Which one is maybe the momentum leader type stock? Which one is potentially the group theme leader type stock? Do we grade one higher than each in terms of both? So if we just start with the momentum leader style side of things, so what are we looking for? We're looking for quickness, right? We're looking for high 20-day ADR percentages. We're looking for a really good 50-day average dollar volume, so the stock is nice and liquid. We're looking for good relative strength. Potentially there's a high short interest in the stock, which can just be a little cherry on top, right? But if we take a look, what do you notice? Well, the 20-day ADR percentage of Pure Storage is 3.56%. What's NTAP? Well, it's 1.96%. So it's reasonable to deduce, okay, if NTAP is going to rally, Pure Storage could go up a higher degree of percentage. I don't want to put an exact figure on it because it's not linear. It tends to be kind of exponential in nature, but it's reasonable to deduce that Pure Storage is likely going to be quicker and can likely move further. Okay, because of the 20-day ADR percentage, all things being equal in terms of the strength and things like that. So then we could also think about the initial risk. We could then go look at like the Market Smith fundamentals. You can go look at earnings, sales, and all of that stuff. I won't do it here for brevity's sake. Then we could also think about the initial stop loss relative to the 20-day ADR percentage. So if we look at Pure Storage, well, it's going to be about 3.94%, assuming perfect execution, versus a 20-day ADR percentage, 3.56, a little bit above. Ideally, it would be less, but shakeout demand tail is going to be around 20-day ADR percentage, potentially within 1.5 times that. NTAP, okay, 2.11, still greater than the 20-day ADR percentage. So already I'm favoring Pure Storage here, everything being equal. I'm going, okay, better earnings reaction, quicker stock. We can check the liquidity and things like that. We could look at the earnings to sales. But for me, I like going more so where there is going to be the quickness. So for me, I'd be going for Pure Storage here. So if we just play these forward to present day, just to illustrate the point, and let's do this one here for NTAP as well. Okay, so both stocks have rallied. NTAP has been able to go up about 8.22%, whereas Pure Storage from that time there has been able to go up around about twice that. So the ADR is not twice, it's now quite close to twice that. But do you see what I mean? It's not necessarily kind of linear in nature. Oh, the stock's 20-day ADR percentage is twice that of the other one, therefore it's going to go up 2 times more. It doesn't quite work like, I mean, you could use it as a rule of thumb if you want, but it's not that linear in nature. But this is the point here about trying to focus on the quicker stocks. Okay. So focusing on the quicker stocks in the group, because oftentimes they will set up around the same time. You can see those setups there, setting up around the same time. But you want to be in the stock, all things being equal, that goes up 8%, or do you want to be in the stock that goes up 16%? And again, that's why we spoke about the initial stop loss relative to the stock's 20-day ADR percentage. If NTAP's initial stop loss was, say, 1% and it was half the 20-day ADR percentage, well, then maybe you may go, actually, I prefer NTAP because actually the initial stop relative to the 20-day ADR percentage is much more favorable. Again, it's not black and white. We trade in shades of gray, but you've got to know the inputs that you're putting into your trading and go, okay, why am I doing what I'm doing when I'm doing it? That's really important. And hopefully everything is thorough and everything is really, really thought out. So let's go and do another one here, okay? So this time here, what have we got? We've got Enphase Energy. I'm back when, remember TAN, when it was showing a lot of relative strength that we were going through. So what I've got here is I've got Enphase Energy on the top and I've got Canadian Solar on the bottom, right? So both of them are arguably setting up, okay? They're more, Canadian Solar is okay. Both of them are like shakeout demand tail S. They're a little bit more on the doji side than shakeout demand tails, but they help illustrate a point that I'm going to try and make here. So if you look at the technical strength, which stock is stronger? And hopefully, now you've heard me ramble for 40 minutes. You've gone, well, Canadian Solo is stronger jack. Why? Because look, builds high lows here, holds above the 50-day, whereas Enphase Energy pulls back down to the 50-day. Okay, good. There's a big shakeout demand tail, potentially presence of large operators, and then it kind of holds around the 50. Good gap down reversal bar, bullish engulfing candlestick there. Okay, puts in that there. But Canadian Solar, from a technical standpoint, is stronger, right? It's held well above the 50-day. What do you notice as well in terms of the RS line? Well, there's 52-week highs here on Canadian Solar. There's no 52-week highs here. If you look at the relative strength line here, it's much stronger than that of Enphase Energy. Canadian Solar is our leader in this instance here. Now, you could be doing your work and going, okay, yeah, Canadian Solar, is it the TML? Is it the momentum leader type stock? Is that Enphase Energy? Now, let me just try and get this to where you can see it a little bit more easily. Something like that. So the 20-day ADR percentage of Enphase Energy at this moment in time, 7.42%. It's a quick stock, right? If you look at Canadian Solar, 6.36%. Then what you could do is you could think about the initial stop relative to the 20-day ADR percentage. 4.86% off an ADR of 7.42% is more favorable in terms of the initial risk metric than Canadian Solar, 5.5% off an ADR percentage of 6.36%. Enphase Energy wins that one. So it's kind of like a checklist in your brain, right? You're kind of going, okay, Canadian Solar wins that one there, but Enphase Energy there, that one there, that one there. Okay, there's going to be pros and cons to each stock. Canadian Solar may have better earnings, but Enphase Energy has better sales coming through, has better estimates coming through. What I will often default to is the market's opinion and go, well, the market seems to prefer Canadian Solar because it's held above its 50-day, whereas Enphase Energy kind of rolled down and chopped around it, right? So if we just play these forward, let's do this, and let's just do this like this, and we'll just go to that point there, which is the 15th of October, and let's go to the 15th of October with Canadian Solar, right? Let's go. Did I do that to the right one? I think so. Not too sure what I did there. There we go, like that. Okay, 15th of October is where I want to go to. 13th, 14th, 15th of October, like this. Okay, so both of them go on good rallies. We just take a measuring tool from one goes up 28%, and this one here goes up 55%. So this is then the thing. You can then look back in time and go, because now I seem like a hypocrite, don't I? Because you're like, well, hang on a minute. You were saying that Canadian Solar is the better one, but Enphase Energy has gone up 55%, whereas Canadian Solar has only gone up 26%. That can happen. That can happen. But if you understand your reasoning for, well, at that moment in time, I only had the information that I had on the 24th, sorry, of September. And this is why I decided to go for Canadian Solar over Enphase Energy, or what it may be. You can then go back and you can analyze and go, well, did I potentially miss something? Again, everything is a skill set. Everything is trainable. You can go back and you can look at your identification and the inputs you were putting into it and go, okay, well, actually, the reason that I went for Canadian Solar over Enphase Energy is A, B, C, D, E, F, G. And actually, Enphase Energy displayed some parts that were better. It was quicker, had a high ADR percentage. Maybe the estimates were better. We can go back and we can look at that. And we can go, okay, was there something we potentially missed at? Well, sometimes you just go, it is what it is. I decided to go for that stock. There was no apparent reason why Enphase Energy should have rallied more, but it did. And that's absolutely fine. If we go for, which other ones have I got? Let's go for, let's do HMY. So this is one that I'm in at the time of filming, so I can talk about this one, right? So if you look at Newmont, okay, so Newmont is one of the big boys. We'll bring in some kind of fundamentals for the last one here. So Newmont is one of the bigger boys, right? So you also got to think about where are the institutions potentially going to go or not go. So Newmont, we were talking about this one a little bit earlier on. Mining, gold, silver, gems, strong group, 8 out of 197. Good market cap on it, 51 billion. Okay, institutions going to be looking at that if they want exposure in this group, potentially, right? Because there's some good liquidity. They're probably not going to be going for a 500 million market cap stock. Fidelity, JP Morgan's just are not going to do that. That's just exploration, and they are somewhere drilling somewhere for a gold mine, and they have no earnings, no cash flow, right? They're probably not going to be there, your Fidelities and JP Morgans of the world, right? What do you see here? Okay, earnings are improving, sales are improving, estimates 53%, 22%, guidance has been raised, but look at it. See how it's all the way down here? Why is it all the way down here? If we go for HMY, what do we notice? Okay, the market cap is 6.2 billion. It's not mega, but remember the point we were making earlier? Look at the higher high. Okay, while Newmont is down here somewhere, why is HMY up here? Look at the earnings coming through. Triple digit earnings. Sales accelerating as well. Sequential growth from recent quarters. Estimates going into all-time high territory over the last 8 years. This year, 148%. Next year, 28%, with the guidance being raised. Highest annual EPS expected over the last 8 years, and I think that will go back even further. Maybe many, many, many years. Maybe that's an all-time high. So now what we have is we have a stock that is displaying some TML type characteristics, and then if we start looking at, say, the liquidity of the stock, we can look at the 20-day ADR percentage of the stock as well. And kind of go, okay, yeah, it's quicker than the group, say GDX. It's quicker than Newmont, which is 3.25%. But you see how Newmont here, it's down by its 200-day. You can't even currently see the 200-day on the HMY chart. It's down there. Like, why is HMY so much stronger? Why is it so much stronger? And then you start looking around the lows of the base and you're like, well, does it look like large operators still want this? Shakeout demand tail, gap down reversal bar, trigger bar, shakeout demand tail, gap down reversal bar. So we then just play these ones forward. We'll just close the that there like that, right? So we then start playing these ones forward, and let's just auto fit these ones. So Newmont is currently up from that point there, is up 6.25%. You may be really happy with that. HMY, on the other hand, is up 13%. Which one do you want to be in? Like, which ones you want to be in? So this is where the importance of it's not just one thing, but relative strength is a big, big, big thing. Like, it's huge. You've really got to focus on it. Relative strength. Now, sometimes, as you saw with the solar stocks, Canadian solar versus Enphase Energy, sometimes you can make the decision with the information you currently have, and you're like, well, Enphase Energy went up 55%, and the other one went up 28%. Just is what it is sometimes. But as long as you understand, okay, this is why I'm targeting HMY. So for me, I was targeting the HMY on that session there. The reason I'm targeting HMY above, Newmont above, Barrick Gold above, Gold Miner, ABCD, XYF. XYF, that was the dyslexia. XYZ is what I was trying to say. I knew why I was targeting this stock here, and I knew the inputs that I was putting into the identification. So this is a really important component when you're thinking about how you identify trades. Like, there's a lot that goes into how you identify trades, because that is really the foundation in which you build upon. Okay, everything starts with, how do you identify a high quality setup? Like, how do you identify what you think is a high quality opportunity? And then how do we control the risk? How do we mitigate the risk? How do we optimize the profits? If I just spin back here, hopefully you can kind of see, because that was kind of a really big part in terms of the last 6 weeks, right? Hopefully you can kind of see the logical flow that we're going to be going through. First and foremost, you've got to start with the foundations. Okay, these setups, these candlesticks, the moving averages, where they happen in relation to each other. It's happened for the last 100 years. It will happen for as long as the stock market's here. It's buying and selling. It's accumulation and distribution. It's institutions accumulating positions and distributing positions. It's never going to change. It just won't change. It's timeless. 3 types of stocks to trade. And then you start understanding more about, okay, these are what TML type stocks look like in terms of characteristics. These are the characteristics of momentum leaders, and there can be crossover. Crossover is good. We like that. Then group theme leaders as well. Okay, specifically, what are the groups? What are the areas? What are the themes displaying a lot of relative strength? And then can you identify the TMLs within that group, or the momentum leaders, and all the momentum leaders? Might be both. The TML may also be the momentum leader. Check, check. That happens. And then we go into additional information, which we'll talk about that a little bit later on. The next couple of weeks, chart setup, how to scan for setups, which we'll be talking about that. We'll be talking about relative strength rotations that feeds into group theme leaders, right? Trying to follow the turns, trying to follow the wiggles and jiggles. Okay, there's relative strength here, now there's relative weakness. Now this area is setting up. What are the individual stocks doing? And then we start going into the controlling risk, the risk mitigation, and optimizing profits. So hopefully by the end of the 30 weeks or whatever it's going to be, you'll basically know everything I know about trading, which is the point in which I'm trying to get you to.